I'm Larry Mastropieri. I'm the broker owner of the Mastropieri Group, and I am here with Drew Monaghan, the president of the Private Exchange Group. And today we're going to talk about 1031 exchanges and a lot of stuff surrounding that. Drew, thanks for joining. And Drew, why don't we start with you just telling us a little bit about who Drew is?
Oh, thanks, Larry. Very happy to be here. Thanks for inviting me.
Of course.
So who I am, business development guy. I've been in business about 20 years. But before that, family guy. Have 5 kids.
Oh, wow. I didn't know that.
Yeah, I've been in Florida since 1999. And do a mixture of, family balance with work balance and stuff. Obviously, we don't punch a clock in what we do, right, Larry?
Sure.
So for us, it's about balance, but I found a good balance with what I do now because I love it, with the family as well.
Cool. So where were you living before you moved to Florida? And how long have you been in Florida?
Well, good question. I moved from New York.
Okay.
Long Island, to be exact. It was a job up there. Moved down here for a new opportunity, new start with different directions with the family and stuff, and then got into 1031s after that.
Yeah, how did that happen? Because this is very niche. And then how did you come to owning your own company in 1031 exchanges?
Wow, it's one of those stories that wasn't in the plans per se. Like I didn't say, hey, you know what? How do I get into the 1031 business? That really doesn't happen that way. But so I was in Florida and moved from one job to another. And I got a headhunter call me up one day and said, I have an opportunity for you for a 1031 exchange. And I go, that's great. He goes, do you know what that is? I said, yeah, I went through that in my real estate class for about 5 minutes.
Yeah.
And the more I found out about it, I was like, wow, tell me more. And then I interviewed for it, and I took a job with a company out of California back in 2003. When the market did what it did, with the market crash, they closed like a lot of companies did. And I went out on my own in 2008. We didn't know, we didn't have any warning that was going to happen, obviously. And I love what I did. And my reputation was pretty much my brand. And when I went out on my own, I told customers, hey, it's my company now. You know what they said? Oh, we thought it was your company all along, Drew. And I'm like, why did I wait? But that's not, It wouldn't have happened early. But that's kind of how it happened. It just evolved from a headhunter calling me one day.
Yeah. So what was that experience like starting a company? Obviously, I'm an entrepreneur. I own my own brokerage. And I always like to kind of talk about that experience with all my guests.
So it was, I've always wanted to own my own company, but never found the right fit. And really, it took courage because starting your own company and pulling away from that paycheck, the guaranteed quote unquote paycheck, which really isn't because a company, can move on, you can move on, was not my first choice, believe it or not, even though I wanted to do that. But when the company closed, I said to my wife, I said, I think I can do this on my own because I was really a student of the business. I asked so many questions because a lot of the information that I got in the beginning to me wasn't good enough. Like when I would want to talk to a client, I want to talk education-wise and bring them up to speed on what this is because nobody really knows what this is. And the answers I was getting were really made me drive for more questions. And because of that process of being a student, I was able to, at that point, which was the right time for me to go out on my own, to really do this on my own. And that's how it evolved.
And that's why you're here. That's why I've worked with you so many times because I think you are great I think you really know your craft and you're really good at explaining it to customers. And that's why I wanted to do this today because I think you're so good at it. I think this will be super helpful. But I wanted to also comment on 2008 is when you started your business in the midst of the chaos, right?
Yeah.
Man, that takes...
It's not for everybody.
Yeah.
It's not for everybody. Well, it happened like without planning. Company closed. I didn't have any warning. And I said to my wife, let me do this. She goes, I don't know. And I said, I don't know either. But I know enough and I know I can make it work because I had such a good following already. But the first couple of years were tough because the market had collapsed so much. There wasn't a lot of equity in properties. And if there's no equity, we'll get to that later, but there was no equity, there's not much to exchange to get the benefits. Mm-hmm. So I used that time to really develop my whole process because it's one thing to process exchanges, another thing to actually do your version of it or your approach or your experience that I wanted to create for the clients that didn't exist at the time. In fact, a lot of it doesn't exist now. What we do is unique from other companies. And it took me time to do that, which was great in one way. Financially, it was a little bit tough in the beginning, obviously like starting a business. So worked other things and kept things going. And the nice thing is I would get calls from people that I had not talked to in a couple of years. Hey, you still doing 1031s? And my comment was early and often. twice on Sunday. I'm ready to go. So no, but that was a motivation for me, and it kind of it was kind of solidified that I made the right decision.
Yeah, absolutely. That's and I don't know if you know my background as much. So I was an engineer. I graduated with a mechanical engineering degree,
Wow.
and I was working for Waste Management and General Electric for many years, and I was also working as a real estate broker at that time too. But I made that leap as well. But I made that leap not in the midst of a huge global recession, right? So,
Yes.
I mean, that is epic.
Yeah, and also it brought back everything that I've done prior to that. My experience has always been business development. You could say it was sales, but I was beyond that. I was more relationship selling and more understanding the niche of a business or the angles of a business, and to understand how that business got done from different angles, not just working there and selling a product or service. And all of what I'd done prior to that really helped me establish this and hit the ground running. For example, we didn't have a lot of costs in the beginning. I'm not going to needed a lot of overhead per se. We did what we needed to do to protect our clients and set up a right business. And had I not had the experience before, I wouldn't have known that.
Yeah, I took a lot from my previous careers too, and I was also in technical sales / business development. So I think there's a lot to be learned from previous careers and applying to the new businesses that I've started, you started.
Well, plus being an engineer, that's a very precise focus, right? You have to dot the I's, cross the T's. You need that in business.
And that's why I gravitate to working with people like yourself that are just super technical. They really understand. And I think as we progress here and talk about 1031s, people will realize what I mean by that.
Right.
But I think that's really important, and I really gravitate towards that. And again, that's why I have
Well, it's funny you say that. I would say my old company, I would go to closings because I wanted to meet the people I was talking to. I wanted to get more behind. I have a lot of conversations with our attorney. And they would say, well, why are you doing that? I said, well, why would I not do that? To me, it was just fundamental. It wasn't to start my own company. It was to learn the craft and learn what I did so I can be better at serving the clients.
Yeah, I think there's that innate curiosity. And if you love what you do, that curiosity grows, and you just ask questions and you just get better every time.
Yeah.
And actually, that's a good comment you just made. You go to the closings in most cases for our clients, right? And I think that's awesome, because I think, people are putting a lot of trust in you. And so them meeting you either before or at the end, at the closing, I think that really builds the relationship, the team relationship as a whole. So,
yeah, people want to know who they're dealing with, right?
Yeah, absolutely. And another reason why we're doing this. So tell me about, I'm always curious about this too when I talk to business owners. Tell me about building your team, who's on your team, how was that process? How do you think about hiring? What's your goals? So
it's funny you say that. I focus on what we need to do the business effectively, right? So the first thing I set up was a good process that could handle volume, because in our business, it's structured where it's more volume-based business, transactional, right? Processing and stuff, which we'll get into more specifics later. But so first I was focusing on that so that when I bring somebody on, they can easily adapt to this process, because it's not the type of business that I could go and hire somebody who's worked in it before. So if that's the case, how are you going to hire somebody and have to train them from scratch, basically not knowing it? So I started looking at things like people that are conscientious, people that are focused and want to do better at their job. And they don't need to be micromanaged. They can also learn quickly, right? So those are the kind of things that I set up with the process first. So then when I brought somebody on, they can get up to speed pretty quickly. So we have a team typically of about 4 people, believe it or not. And we can handle a big volume that way because of the process and because of the training. So we have an attorney, we have a CPA, obviously there are go-to people. We have a couple of coordinators. Actually, my wife helps with translations because she speaks 3 languages.
Oh, wow.
Yeah, so she speaks Spanish and Portuguese as well as English. So we bring that in because we want them, not from a technical side initially, but a comfort side, to be able to speak to somebody in their comfortable language if they need us to. And a lot of times they already know, but to have that little extra is more comforting to them. So that's kind of how we focused on the team side. And we bring on people. As we expand, we'll bring on people, because I realized based on a certain volume, what each coordinator can handle. So as we expand, we bring on another coordinator, and that's how we do it, kind of like adding in as we need to.
Yeah, interesting. So what are your goals with your company? What excites you?
Wow, that is a big question.
Yeah.
So we're at a point now where we're bigger than the company I worked for before.
Wow.
And the company I worked for before had about 9 offices around the country. And we pull our business from many states at this point. We actually do business in most of the states just because of word of mouth. But to answer your question, I would like to double where we are again. Like we don't really need to. We're fine. We're very comfortable. We're very blessed, actually. So from just a future standpoint, and maybe sell the business in the future, maybe not, or pass it on. I'm not sure that part yet, and that's okay. I'm not needing to decide on any of that anytime soon. But I'm looking at getting it larger to be more easier to sell or pass on. Right, so it's that kind of a structure I'm looking for, but I don't have to. Where we're at now, like I said,
that's kind of how I think about either my investment side of the business or my brokerage business. Same, I'm at a point where we need to get a little bit bigger to have more homogeneous operations, so everybody is systematically working together, and it's a little bit more calm and collective, right? Instead of we're all doing a lot of things, which is a great thing for the customer too, because we're all very talented and very skilled and touch every part of the business.
Right.
But when you can create a process like you just said, where you have coordinators focus on coordinating only,
right.
It becomes very efficient, right? And that's where I'm at. I'm trying to get a little bit bigger so we can be there.
Yeah, and for us to, on that note, it's not just necessarily one direction in the future or not, just to see where it lands, but it's like you said, it's also for consistency, because I don't want to be huge as far as the size of the personnel at the company, but losing that personal touch. I mean, that's the key about what we do for a living. I mean, it's anybody could process exchanges kind of sort of once you get up to speed on it. But the consulting side, the education side is unique. And I don't want to lose that, nor will we lose that, no matter how big we get or not.
And that's my core focus, right? The customer experience.
Exactly.
And delivering. And I put a lot of emphasis on this just because of my background, and you do too, which is just like delivering great advice and coaching on how to proceed. Because that's what I do on the brokerage side. That's what you do from a 1031 exchange perspective. Yeah. So the other question I always like to ask is, what lessons have you learned? What hurdles, like where were the moments where you're like, oh my gosh, like, I don't know if this is going to work, or we definitely have an issue here. Like how did you get beyond that? And what type of lessons have you learned? So
it's funny you say that. I was just talking about this the other day with somebody, because when I have my calls with clients, sometimes we go deeper and we talk about each other, and that's just the natural flow of the conversation. One of the things I mentioned was the first couple of years, and I think it was only because the way the market was. If the market wasn't collapsed like it was, there wouldn't have been a struggle, because me, it was just more of the same, and I would just go on my way. But because the market was still in the verge of trying to come back, we were lucky on 2 factors. One, Florida was one of the first markets that came back, as you know, right? The second thing is that we kept the expenses low, no debt, just kept what we need to do to take care of the client, as I mentioned earlier. And there was a time, I think, in about a couple years into it, I was working a couple jobs too, like a lot of people do, to keep the business going, this and that. And I got a call from an attorney in Palm Beach on the island. And I'd known him at that point, I don't know, 8-9 years at that point. And he said, hey, you still doing exchanges? I said, absolutely. Every day, twice on Sunday, the same thing. And he gave me a very complicated exchange. And I knew how to do them already, right? So I said, I'm happy to do it. Awesome. I turned to my wife and I said, guess what? I think we're going to go back full time now. And we're going to go after this. And she turned to me and she said, I don't know yet. I don't know if he'll do that. And I said, Sarah, I don't have the luxury of that belief. So the commitment to that focus, and to have the caveats that said, we will make this happen regardless of what the market's doing, and we'll find a way to make it happen, is what drove it. Now, what's interesting about fear, I was afraid, like a lot of, I guess, first-time business owners, would be like, well, what if I don't have any income coming in? How am I going to pay my bills? I don't have a paycheck. That was actually part of it, but part of other fears came in. One of them was, what if I can't handle it? What if there's too much business coming in? And I didn't expect that one, actually, because I didn't have the nerve of thinking that I could be super successful right away. And I was shocked that I had that thought came across my head. I'm like, holy mackerel. Well, I faced that about 1.5 years ago, because the business exploded. And we were having a tough time keeping it up. But because we had the good process in place, we're able to handle it. So there was like a stress test, if you will, that we were able to get past. Right. So that was the transition.
That's awesome. Foundation is so key, right?
Yeah.
I focus on that so much every day. Foundation, systems, processes.
Right.
Yeah.
So, but back to that, and that's what I held firm on, those basic fundamentals, and just the belief of I will make it work. Not arrogance, not false optimism. Just, you know how to do this. You've been at it a long time at this point, and the business is out there. It really is. So.
I believe in that, the persistence, and especially if you're committed to learning and adapting and adjusting as you move forward, you're going to get there. And it just depends on when, right? So sometimes you hit it and you get lucky and maybe it happens faster. Other times it takes a little bit more time, right?
Exactly.
And so that is definitely a trait of a successful entrepreneur, I would say, for sure.
Yeah.
So that's awesome. Cool. Let's get into 1031 exchanges. So tell me, give me, I guess I know you have a couple ways of defining 1031 exchanges, because you and I have obviously done a handful of these together and we've worked with clients together on this topic. Right. So I've been through this with you a bunch of different ways, a bunch of different types of exchanges. But could you just define 1031 exchanges, maybe the layman's terms way, right? And then give as much detail as you like.
Yeah. So the technical definition is a process by which a real estate investor can sell and reinvest their funds from investment properties and take up to 100% deferral of capital gains and depreciation recapture taxes. That's the technical definition, but I don't use it. Isn't that funny, right?
Yeah.
What I prefer to say is to somebody, it's like playing Monopoly for real, where you're literally moving your pieces around the board and you're making decisions that improve your portfolio in the process. And by the way, you're not having to pay the tax while you're doing that. You're not getting out of the tax per se. I mean, you could eventually with a stepped up basis, which we can talk about later. But in that specific movement in improving the portfolio, you're not having to be burdened by paying a tax, which cuts into your equity and your power and the real strength of the portfolio. So you can free to move pieces around and make it better for whatever that means to them. So we really spend time with clients starting there. I say, you're at A, you're trying to get to B. Tell me what B looks like for you. And then from that process, we're able to take them in directions, some cases where they already were going, other cases they didn't know they can go different directions. And that's really the power behind this, is understand that it's a tool and it's basically a section of the tax code that allows them to do this.
Yeah, I think what is great when we get on the phone together with clients, or you get on the phone with the client when I pass them along to you, is, you come from a place of, let's understand what your goals are and let's talk strategy on how we can achieve those goals, and right. Or let's just talk strategy around, is this really what you are looking for?
Exactly.
Right? And sometimes the client comes out of it saying, oh, well, I just learned a whole bunch. I'm actually trying to do X after talking to Drew, right?
Yeah.
Not what I initially had
exactly.
in mind.
Yeah. And as a handoff to a broker, it could save time, usually, right? It also is more efficient with time, so that if you're in a short period of time, if somebody finds out about an exchange last minute, their time is compressed, so they can't waste time. So, but they don't want to rush either, right? It's kind of that balance. So I found it to be very powerful for all the team to say, once we have a set plan that they're now buying into, now we're all focused on the same direction, full steam ahead. It's really powerful.
Yeah, that's great. And that's what you spend your day doing mostly, is coaching, consulting, however you want to define it, just strategizing, right? Handling that high level topic so then the foundation's right, we know what we want to do, brokers on the same page, attorneys on the same page, accountants on the same page, clients on the same page, and then we can move forward and everyone can execute accordingly, right? So,
and it's interesting too, I'm not allowed to give tax or legal advice, right? You aren't either, right?
Yep.
But we're talking about tax issues. So the way we approach that is the team, as you just mentioned. Very powerful. We'll bring people up to speed. I can educate and point you, but I need your team, and you need your team to solidify that, right? And that's how it works very well. And usually CPAs are complimentary and appreciative of what we do, because they're brought in earlier than they sometimes normally would, or sometimes somebody doesn't have a CPA that now they're going to engage one, which is critical.
Yeah. So I like how you talk about playing Monopoly for real. And what I've heard you say in the past is and I think this is how I visualize it best, is basically when you have Monopoly, when you're playing Monopoly, you have 4 houses on the board, right? And then the goal is basically you're going to trade all those 4 houses in for a hotel.
Right.
And that's basically the concept, right? You can do it. There's a few different ways you could do it, right? I think you've mentioned you could trade 1 for 1. You could trade 1 for 10, 10 for 1, right?
Yeah.
So you could do a lot of different things, but that's the general concept, and that's why you use that monopoly term.
And it's funny, I watched a client do that back in like 06, 07 or something like that. Sold a property here in Boca and actually bought 7 in another area. And I'm like, whoa, it's like playing Monopoly for real. I was like, bingo. And the nice thing is you take something that somebody knows, and usually they're very emotional about it, right? They have a good experience with the game. Plus or minus sometimes, right?
Yeah.
And then tied with something they don't know or they don't think they know. And then I'm like, it doesn't have to be 4 to 1. It could be 1 to 1. But just open your mind to say, okay, I'm trying to get here. Oh, I didn't know I could fill in the blank. And that's what I want them thinking early on as much as possible, because then they can move their houses around or their commercial property, whatever it is, in a better position for them.
Yeah.
Even in a really high market, actually. So it works very well no matter what market we're in.
We could talk a little bit about that too, just like why you would do it in that situation too. But the first thing that a lot of people ask me when they're super new to this or have no idea, if it's a deferred tax exchange, so if you're deferring taxes, why not just pay the taxes now, get that over with? Because in the future, who knows how much taxes are going to be on something. So why don't you elaborate on why you would even do this, given my question? Yeah.
Absolutely. It's a great question. And it's a question I would ask if I was a customer. I would say, wait a minute, you're just putting it off. My accountant says the tax rate might go up. And if it goes up, better pay it now. My question back to them is, why are you in real estate investing? It's quadruple compounding, right? You're making money in appreciation. You're making money with depreciation. You get a tax credit every year. You're making money in cash flow. And you're also making money by time value of money. Because if you pay tax in today's dollars are worth more than future dollars because of inflation. I don't have to tell you what inflation is right now, right? So it actually benefits you if you cannot use today's dollars, repurpose them into another asset that's better producing for you, whatever that means. It could be more income. It could be easier management. It could be no management. It could be taking land and make it into something that produces income, or multiple streams because you don't want all your eggs in one basket, for say. So there's many different ways that it can go. And that's really the strength of it, not getting out of taxes. You can do that eventually, but that's not really the benefit. The benefit is to preserve what you have and build on it.
I think that's super powerful. And then finally, you can defer taxes unlimitedly and indefinitely, right?
Yes.
So elaborate on that a little bit, what I mean by that.
Right. So if you look at first paragraph of the section 1031 in the tax code, you can read it because you're a detail guy. You definitely do that. Not everybody's going to read it. I read it long time ago. And basically what it talks about is usage of property, of real property, either used as a business or used to make money. Like they call it investment, using it to make money. And if you're using it for both of those usages and it's real property, you can exchange it for other things, right? The difference is that some people don't realize that could be go in a lot of different directions, right? So anyway, back to the question. Can you tell me the question again?
Deferring indefinitely.
Oh yeah. So
and what does that mean and why?
Sorry about that. Yeah. So the idea is that it's indefinite because you don't create a tax until you sell something. Any product or service that you have, as soon as you pay money for it, or you're receiving money for something you're selling, a tax is generated potentially, right? Unless you have a loss or something.
Touch the money, you pay the tax.
Exactly. That's one of my phrases. Touch the money, pay tax, right? Yeah. So if you don't touch it, you don't pay. So by doing an exchange, you're basically a deed swap. Okay, you're swapping one deed for another. That's why it works. It's been in the tax code 102 years at this point. So it's not a loophole. It's not some special program that is only for a certain group of people. It's for any taxpayer anywhere that's doing a process of swapping properties. Now, the key is you could swap properties today. You don't need us for that. If you had somebody you swapped a deed with, that let's say the two properties are saying they're worth the same amount and they have no encumbrances, no debts, we're just going to swap deeds with each other. You can do that. Maybe use an attorney, obviously you want to do that. But by swapping those deeds, you haven't created a taxable event. Therefore, there's nothing to tax you. Well, with the 1031, because there's money involved, you can sell to whoever and you can buy from whoever. That's where an intermediary comes in, and we'll go into it more later. But that intermediary holding the funds, sending the funds, keeps you from touching that money. Therefore, you have not touched any money to pay the tax on. And there's nothing at that point for them to calculate unless there's money that you touched. And it's unlimited because they don't have a limit on it because there isn't reason to have a limit on it.
You can do it as many times as you want.
Yeah.
Just continue to compound.
Indefinite means through your whole life. The only time you have to consider it is when you are selling something because that potentially causes a taxable event.
Yeah, that's powerful, right?
Yeah.
And I've heard stories of individuals who have done this indefinitely and deferred taxes even in death, they say.
Right.
And taxes in death.
What's interesting too is when you say you can do it multiple times, there is no limit, but you cannot use the property. Let me back up. So there's basically three fundamental usage of property. There could be more than that, but just three concepts. First is primary residence. Primary residence, 2 out of the last 5 years, people know that. Your accountant can confirm if it qualifies. But when you sell your primary residence, you get up to $250K of the gain exempted if you're single, up to $500K of the gain exempted if you're married. So people say, that's great, but what if I made more than that? Well, guess what? That's the limit. But it's also limited by that usage, right? Second usage is flipping properties, and there's nothing wrong with flipping properties. But when you flip a property, in a sense, you're treating it like inventory. No different than buying any asset, phones, desks, whatever, and selling it at a markup, buying low, selling high. That's called income. It doesn't matter how long you've owned it. That's taxable. You cannot have a deferred tax on that. So the unique thing with 1031s is, yes, it's unlimited with dollars and also unlimited amount of times, but you don't want to be flipping properties into one either. So it goes back to when we have the conversation with them. All right, how have you used this property, let's say in the last 2 years? If it's investment, meaning I'm using it to make money, I'm renting it if it's rentable, or land, I'm holding on to it, right? Then you can quote unquote qualify it internally. You don't have to submit to the IRS to qualify it, but you're just saying that we believe that when we did this exchange, that this property qualified because we used it as an investment. Here's the activity. Here's the scheduling on our 1099 on our tax return, showing that we used it. Here's the rental income, and the property we bought we used the same way, and that kind of solidifies the two usages and allows that to happen. Now that you can do unlimited, you just don't want to flip properties into doing that. That's the only thing.
Yeah, very good point. Like flippers, this doesn't really work for you. We can talk a little bit more about how people's plans change and how you can then qualify. You initially were thinking about flipping it, and then now it turned into an investment property and a rental property, whatever. Exactly. And now you're going to sell it. You can elaborate on that a little later. Yeah. I want to step back real quick. So it's called the 1031 exchange because it's the 1031 section of the tax code, right?
Exactly.
Okay.
Yep.
Okay, cool. And then initially this was created, like you just said, 100 plus years ago, and it was created for some history for this is like it was created for farmers, right?
Well, that was one of the commonmost things. People would, let's say two farmers are swapping deeds because they want to use the property for different ways with the soil, whatever it was back then. It's not just farmers, but somebody wants to swap a deed with somebody. There's no taxable event. That's the core of what it is today. It's deed swapping. It's just not direct swap.
Exactly.
Usually.
Because there's money involved and there's different pricing.
But exactly. And that's why it's not a loophole. It's not like something that would be another revenue generation for the IRS that they're letting go and stuff like that. It's like anything else. For example, you have an asset that goes down in value like a car. You get a credit. How real estate goes up, it's a gain, right? So it's a flow of how the asset and what the asset does more than a tax loophole. And that's the key for people to understand. It's not a loophole and it's not some special program for certain groups of people. It could be, we've done exchanges with property that's worth $100,000 and well over 30 million. So it doesn't really matter the size. It's just a matter of what the usage is. And by the way, how much tax you have to pay if you don't do it.
Sure. And
what your goals are. But we can cover that with the conversation.
Yeah, exactly. When we talk more strategy, and I have a handful of questions that I want to pick your brain on too.
Yeah.
Who can do this? You kind of just mentioned it, but also, and where can you do it?
Fantastic question. So if you remember, it's part of the United States tax code. It covers any United States taxpayer, not necessarily a citizen. So you have to be a taxpayer to take advantage of this. You can't take advantage of something in a system that you're not a part of.
Sure.
So if you're foreign national, obviously any taxpayer in the United States covered. If you're foreign national, you have to become a taxpayer and file paperwork with your CPA to let the IRS know that, yes, I'm going to start doing this, and here's the idea on this property we're selling. So regardless, you have to do that. Now, if you sell a property in the United States, you can replace with any other property in the United States. If you have properties outside the United States, you can do an exchange. As long as if you sell outside and you buy outside, you're good to go. So for example, let's say you sold a property in Singapore and you bought a property in Canada. No problem. Just couldn't go in or out of the United States with that. So it doesn't matter country to country as long as it's outside of. So if they have global income where they're going to be taxed from the United States and this will benefit them, excellent. The only caveat to that would be check with their CPA, both local and the international CPA, to make sure that it's the best fit. Because sometimes, believe it or not, paying the tax in the United States is a better decision than not paying it and having to pay a bigger tax in another country. So it's not an automatic in most cases with that. But I tell them, have that conversation, and we can have a conversation with them at that point, figure it out.
Do you do a handful of those outside the country?
We have, recently.
Interesting.
Yeah, I didn't know we could do that 10 years ago because it never got asked. Yeah. And we didn't pursue that. But we kept getting asked. And we've done a handful of those.
That is pretty neat. Okay.
Yeah.
All right. So the next thing I want to ask you, and I think we should touch on, is just you kind of mentioned it, the two parts of qualifying. I think we talked about this before, like money versus just usage.
Right.
So can you elaborate on what you mean by that?
Yeah. So it's all about usage of money. I mean, to summarize what the tax code's talking about. So it's all about real property. And the way they define real property is anything that the state that the property's in considers real property. So commercial, residential land, 30-year plus lease is considered real property. A co-op, considered real property. A Delaware statutory trust, where you're buying a piece of a trust, that buying a piece of that trust is considered real property. So anything that's considered real property, that's the first thing. Then we get to the usage of money, right? So it's got to be real property for real property. You can't buy an interest in a company. You can't buy stock. You can't, do loans or something like that if you want to lend out money. Can't do that. I mean, you can do that, but it's not considered an exchange.
And so regarding the real property topic, people ask me this occasionally, and it's like, hey, I can sell a piece of land that's used as a piece of land and buy a rental property like a single family home or even a multifamily building. It doesn't matter, right? That's a common myth. You can swap.
And that's why I love the Monopoly analogy, because the greenhouse for the hotel. And I said, that's, as we said before, it's one example. But it's not to be a hotel.
Yep.
It can be anything. It's higher density, higher income, right? So, but that's why I want them thinking like that. But you're right. It doesn't say, if you look in the tax code, it doesn't say anything about type. So whether it's real property improved or not, it's still real property. Okay. And that's the key definition that a lot of people have to realize. And I bring them up to speed on that. So back to the usage. So again, so it's real property used as an investment or run your business out of it. The way they define use as an investment is if it's rentable, you're renting it out. They want to show activity, right? If it's land, okay, you may not be able to rent that out, but you don't want to be flippy. You want to show you're holding it for future use. Seasoning. I call the seasoning, right? Well, it's funny because they don't have a holding period. Like they don't say, hey, listen, Larry, as long as you hold this property for X period of time, you're good to go. You could have a property you owned for 10 years, but never used it, never rented it, and I wouldn't do an exchange on it. How are you going to prove you used it as an investment? To them, it's a second home.
So in the IRS tax code, it does not say you have to hold this property for 1 year, 5 months, 6 months, like 2 years.
No, but they have best practices. They have letter rulings that come out that kind of get an idea how they think about things. And the way I best describe it, as you mentioned, is seasoning. You can't change usage of a property right before a taxable event and then to get a better tax situation. They're not going to let that happen.
Sure.
Oh, well, this is my primary. We made $1 million, but I rented it out for 2 months last year. So I'm going to make an investment because the primary residence only stops at $500,000. They won't let that happen. And if I hear something like that, I'll let them. I say, I wouldn't do an exchange on this one. Your call, but I would not do it.
Exactly. It's the client's decision, right?
Exactly right.
You're just going to give guidance.
And most of the time, in fact, I don't know, many times they have not listened to what I told them.
Yeah.
Because it's not worth it. I mean, if in an audit, they'll bounce it as soon as they look at it. We'll be long gone at that point. The brokerage already has been done. The property transaction has happened. It could happen 2-3 years from now. God forbid you get audited. And they don't, one of the myths is people think that they audit you because you did a 1031. Not true. But if God forbid you get audited and happen to have done a 1031, if I'm an auditor and I've talked to auditors, former auditors over the years, I'm going there first. It's a blip on the screen. A lot of little check balances, little boxes to check, seasoning to check. Very easy to audit. So why would you risk that? And people say, well, what worst thing could happen? I said, it's against the law. I said, no, it's not against the law. But imagine you had a $100,000 tax bill that you didn't pay 3 years ago. Interest and penalties are not cheap.
Yeah.
So that's how we looked at it. They wouldn't prosecute you. It's just you took a deferral that they're not allowing now. So I tell people I wouldn't do that. Be conservative, dot the I's, cross the T's, make sure it's there. So back to the seasoning, they don't call it that, but there's some things, benchmarks, if you will, that we tell people to kind of consider. And the first benchmark is owning it for a year. Because at a year of ownership, it switches from a short-term to a long-term asset. So it starts looking and feeling like an asset you're using to make money now, right? At 2 years is even safer because there's a lot of rulings and letters that came out from the IRS that discussed 2 years this, 2 years that. Look at the primary residence, for example. So we find 2 tax returns is a safer bet to show that, yes, this proves that I seasoned this usage, if you will. That's our terms, not theirs, but it gives the same idea that, yes, this is established as an investment, therefore we think it qualifies for deferment.
Yeah. So that's interesting. So I typically live by the rule of like, I try it, like if I'm going to do this, 2 years makes me feel really comfy.
Right. Exactly. Longer the better, but 2 years should be okay.
Copy that. Okay. Yeah. So let's move back to just to talk about money and usage a little bit more. So money, what do you mean by that?
So we got the usage nailed down, right?
Yeah.
So here's the money side, pretty straightforward. It's net sale price is what you have to spend. So example, let's say you sell a property for $1.1 million and you have $100,000 in closing costs. I'm just throwing numbers out just to kind of illustrate that point. Your net sale price is what they tax you against. And in effect, that's the real value of the property at the time of sale, isn't it? Not your gross price, but what you netted. And that includes any mortgages. I'll cover that in a second. But let's just say you netted an exchange. You didn't do an exchange. You netted $1 million in your pocket. That is what's the amount that has to be respent or reinvested to not pay the tax.
In full.
In full.
Yeah.
Anything less is touch money, pay tax. It's similar to like taking a disbursement out of your 401k. They put any dollars that you go in your pocket to the tax calculation first before you can say, well, wait a minute, I have these offsets, I have these expenses, I have these losses or whatever. They go, hold on, we're going to get paid first. That's how it works, right? So it's top down. So let's say you come in at $950. Well, $50,000 left over is taxable. Full on capital gains, whatever your rate is. And long-term rates right now are either 15 or 20%, depending on your income. So if you made more than $400,000, and by the way, when I say you, I mean the taxable entity. I want to cover that right after
we'll
this.
talk about that. Yep.
Whoever the taxpayer is, if you made more than $400,000, it's 20%. There might also be an Obamacare tax for 3.8, 3.9, I'm not sure exact, in there as well. But I tell them that's what you confirm with your CPA. There's no reason to guess. Get the numbers from them. It shows what applies to you in this situation at this time. If it's less than $400,000, it's 15% flat over a year of ownership, right? So that's where they kind of say, okay, let me see if it's worth it or not to do that. But that's what you're fighting for, if you will, when you do the exchange. You need to be aware of that. So back to the money. So if your net target is, let's say, $1 million, that's what you have to focus on. And we call it a target spend. And I want people to think of it as a target number, not a have to or else number, because it's not. People think, oh, I have to spend this much or more, or I can't do the exchange. That's not true. It's very simple. If you come in less, you pay tax on the difference. But here's the thing. As a broker, you know, if you find a great deal for somebody that meets all their criteria and it's $980, you're not going to overpay by 20.
Yeah.
Take it. Get it done. It solves and fills in all those check boxes that they had for you. That's the criteria. And the 20 grand, okay, pay tax on 20, better to pay tax on 20 than 100.
Let me ask you this.
Yeah.
This is something I've heard recently, and I don't know if it's true or not. All right. So this is why I'm going to ask you this, because you just made a comment. Okay. We find this deal at $980. According to doing the 1031 exchange, the target is $1 million because we netted $1 million on our sale.
Yep.
And so we find this deal at $980, and we want to, and I'm using simple numbers. This was more complicated in practice, what I was recently involved in. And we want to spend 100%. Okay. We want to spend $1 million, right? Can we make an offer at $1 million with a $20,000 credit as an example? Is that a thing? Is that doable? Have you been involved in this?
Yeah, that's great, but you're still going to pay tax on the 20.
So it doesn't matter.
Right. So, but here's how you would handle that. So, and it brings up to the next point of the strategy piece. So let's go back to, we have a target spend of $1 million. It's never going to be exactly $1 million because closing costs are not whole numbers, right? But we use that as just a conversation. Maybe it's $1,098.56 or something like that. Doesn't matter. But that's the target. That's also why it's almost impossible to match the target. Because how are you going to get a purchase that matches exactly to the penny when it has different closing costs than the sale did, right? So I tell people, don't sweat that. So let's say it's $1 million and change, whatever it is. And you say, okay, now what do we do? All right, you have 3 options on how to spend that money. And none of these have an advantage over the other. Some people think, I got to spend more to get the tax credit. I go, no. Okay. It'll help you. You won't pay any taxes, but don't think like that. So your 3 options are buy something larger in dollars. Okay. $1.1 million, $1.5 million, $2 million. Bring partners, cash, or debt for the difference. No brainer. And if you bring a partner, they take a tenant common interest. They take that share of the property. You take yours, whatever. First option, go larger in dollars. Second option, buy something around that price. Like we just said, a little bit under, a little bit over, you're going to be. Don't sweat it. Take it. If it fits your criteria, you got to take it. And I'll get into the extras in a second. Third option is diversify. Buy 4 250s, 2 500s, a 700, a 300. Doesn't matter. Have fun with it. Play Monopoly with it. Figure out what pieces do I want. I want this kind of piece for that. Maybe I want a residential piece I want to move into. I want a commercial piece. It really opens up so many different opportunities for somebody. And I want them focused just on that because, again, it simplifies and makes the use of time more expedient. Okay, go ahead. You have another one.
Oh no, there's so many like
exactly
there's
right,
so many scenarios, and I was
Right.
trying to hold off getting into like all the scenarios because
gotcha.
I have other specific topics that I've been involved in either recently or I have clients considering stuff which have either talked to you already and or will be talking to you here in the future. Right. So back to the money thing. So if you net $1 million, you have to spend $1 million if you don't want it taxed, right?
Correct.
So if you buy a property for $1 million and you buy it cash, cool, right? And just say that like you spend 100% of the $1 million and you're not taxed, right?
That's it.
Or your tax is deferred.
Yep.
But if you take a loan as an example, so now I buy $1 million property, but I take 70% debt on it, and so now I'm only spending $300,000. I still got to spend that other $700, right?
That's correct.
Yeah.
Well, it brings up a good point from structure. So 2 things. First, if you sell a property with no debt, let's say that's the case, that $1 million, whatever the net is, goes right into the exchange account. We'll get into the logistics of the accounts now, but just stay on the strategy for now. That is what you have to spend. You can't replace cash with debt, but you can replace debt with cash. So let's play that out for a second. Let's say you say, you know what? I want to put 30% down on this first property, finance the difference, 700. 700 mortgage, I use 300 the exchange. I got 700 left in the exchange account. You buy another property. I had somebody take that scenario and buy 5 properties, putting 200,000. I changed the numbers just to make the numbers easy. But let's say they put 5 properties in your scenario, 200 down on each one, finance the difference. They expand the portfolio out like that. And I said to the guy at the time, I changed the numbers. Like I said, he was at different numbers, but concept is the same. I said, after the first or second purchase, you could be done with the exchange. You don't have to you could put more money down, get a less mortgage, and be done with the exchange. He goes, and this was before the mortgage rates went up. He goes, oh no, I want to capitalize on that and expand the portfolio. So he made the portfolio 2 or 3 times what he had. Yep. And I was like, whoa. I mean, so I'm learning too. I'm watching how these guys do this, and it's fantastic. That kind of a thing gets you really thinking, what's the best use of this financial target? And that's what I get them thinking. Now, on that note, if it is a mortgage, we need to bring the mortgage person in to have that conversation. Because what you don't want to do in your scenario is, let's say I spent $1 million, I'm done. I'm going to take that 700,000 and do whatever I want with it. I go, no. They go, wait a minute, but I spent $1 million. I said, yeah, but you left 700,000 exposed. If you don't use the rest of that, or any dollars of that you don't use, again, it goes back to the same thing. Touch money, pay tax. So that's what they have to be aware of when they're doing with mortgages. Yeah.
So my general thesis on my personal investment portfolio, which I have about 90 apartments here in the local area, and is if you're using debt and you're doing good deals and your debt's low in that situation, like the rate is low, like that's amazing, right? You just got to keep doing good deals. So that's a theme, I think.
Right.
And we can talk about that a little bit more too. But
right.
But back to this comment, let me make sure I heard you clearly on this. So what if I did this? What if I 1031'd and sold my property, $1 million went to you net to your company. You're holding it for us, and I go spend and buy $1 million property all cash, and then the day after I close $1 million on that deal, I cash out, refi it.
No problem.
No problem, right? So that to me
It's powerful.
is the magic trick.
That's powerful.
Right there, because now you don't have the timeline to go spend that other $700,000, because I'm going to go spend that other $700,000 to buy more property anyway, my personal investment thesis.
Right.
But now I found one asset that matched what I sold and what I needed to spend in order to get the 100% tax deferral. And now I can just take my time and deploy the other $700,000 now that I pulled out 70% of that.
Right. And that original property pays for it.
Exactly.
I mean, that's a fantastic thing. Because some people, honestly, when we talk to clients, we start with engagement letter. We call it a guide and engagement. It's a couple of pages, about 2.5 pages. It explains the whole process. And in that, we ask them a couple of questions. Do you want any cash at closing? We're not promoting it. We want them to know they can do that. Some people are like, well, wait a minute. I touch money, pay tax. Okay, well, let's talk it through. But if you want cash, you can get it. Ask them, if they're foreign national and what when their closing is. Just kind of basic questions. But that causes other things to come up in their mind. Like, for example, let's say they say, there's certain dollars I don't want to put into the exchange. I want to use it for something else. We had a guy recently, I want to do hard money loans. I want to invest in stocks. I want to go on a trip. I want to pay other debts. You can do that. So here's the approach that we talk about with them is that touch a little, pay a little, right? Or not. So let's say you pull out, pick a number, 20 grand, just to throw a number out of the air. Well, if you talk to your CPA and you had a capital asset loss somewhere in your portfolio, stocks or other assets that happen to have a $20,000 loss, you might not owe any tax on that money. So imagine investing everything except for the little bit you don't want to invest and then not having to pay tax on that either. So there's a combination of things there that work. That's why we need the team. A very big, as you can tell already, big proponent on teams, right? And part of that team is the CPA to give us that information. So go back to your CPA and say, hey, I want to take X dollars out. It really doesn't matter the dollar amount. Do I have anything to offset that? Or is there something coming up this year, right, before the year finishes that we can offset that? Maybe they get the best of both worlds. Maybe they don't. But paying tax on 20 better paying tax on 100, especially if they really want that. For whatever reason, it's their business. They don't have to tell us what it is because it doesn't matter to us. But I want them to educate them and be aware of that option. Because sometimes I call it like claustrophobic. They're like, well, I have to put all of it in, but when do I get some for myself? Sure. Like, well, you're getting the cash flow. You get, we go back through it, but they sometimes just don't want to put it all in. And that analogy you brought up is perfect because that's also one of the things we promote. Well, maybe the debt. Well, I don't like debt. Well, cost of tax versus cost of debt. Run the numbers. Again, the numbers are there. They are what they are. Sometimes even with a higher interest rate on mortgage, it's still less expensive than the tax bill they're going to pay on that money. And the property that's going to appreciate and depreciate and cash flow and save on the time value of money, that quadruple we talked about before, are still in play. So when I bring those things to people, they're like, I didn't think of that before. Yet it's all right in front of them, but they need somebody to kind of pull that together. That's what we do. Yeah.
And we've been in conversations together. We've talked about so many different strategies around this, right?
That's what I love about it, man. Yeah. To me, that never gets old. I probably explained the 1031 at this point over 20 years, tens of thousands of times. Maybe I haven't counted, but that's why it doesn't get old for me, Larry, because it's cool. It's unique. Each situation has a unique opportunity or challenge to solve. And that to me is the fun part of it, definitely.
What I find that's kind of interesting about this, and everything needs to line up, is you can do what I just described. So say you sell, for example, I've talked to you about selling some of the duplexes in Boca Raton here that we own and single family homes. And then we own other bigger multifamily buildings. And so we were talking about, well, these duplexes are small. We could sell all of them in a package and or individually, however that works out. Actually, we can talk about that here in a second.
Yeah.
And then I can go buy a bigger building as an example, consolidate, right?
Right.
And we could go buy that cash, then refi. And if you're doing it well, some people who might be watching this understand the BRRRR method, which is buy, renovate, refinance, repeat. Right?
Yeah. Yeah, I got you. You already know you're doing it.
Yeah. And so if you're doing that method, you can buy this thing cash. Maybe you do that work as well. And we can talk about the construction piece of this too.
Yeah.
but maybe you do that work, or maybe you're just able to refinance it. Maybe the value, you pay $1 million because your net is $1 million, but the assets may be worth 1.2 or 1.3. You might be able to pull out $1 million. So in a perfect world, you pull out all the capital you put back into it. Now that's hard to do,
right?
But if you're, in some cases, you do this enough, you get lucky occasionally, right?
Yeah.
And so then you can pull out all that cash, and then you can go do more deals with that. And again, you're not time constrained anymore, and you got so that's a good setup in my opinion.
Yeah, and in my mind, it's always about laying it on the table, and then figuring out the options given the time, given the constraints. And one other thing about the exchange, we'll get into the logistics of it, but you control your own time because you control when you put something in play. So when you decide to sell a property, okay, they're working with you. You can go back to them and say, well, based on the market data right now, it'll get X days before we get to a closing table, roughly. And not a guarantee, but if you look at the market data, you can see how often or how long it will take to get that property to the table, right?
Yeah.
Not guaranteed, but still, right?
Yeah, let's talk about that, I guess, right now. Why not?
Yeah.
So like when I'm working with a client and they're telling me they want to do a 1031 exchange, we start assembling the team. We all have this discussion about what the goals are, what you're trying to do. And there's a whole bunch of different ways to do this. We've done reverse exchanges together. We've done all this other stuff. But depending on the specific client's circumstances, I usually tell them, listen, we can time a little bit when the closing date is, which is when the timing starts. And we can talk more about that later or in a little bit here. So we can time that. When a buyer makes an offer, I'm going to have that discussion with them. Hey, maybe we want to push the closing date 60 days. Maybe we want the right to extend for whatever reason. We can add that to the contract. So maybe I can push this back 90 days. We can start searching. We know the deal's locked up on the sales side, and we can start the hunt. We could start identifying. We could talk about that later. And then when we really feel super comfy, sometimes we even put the deal under contract while we're under contract. Let me clarify. Sometimes we even put the buy side deal under contract while we're under contract on the sell side deal. Right. So now everything feels real comfortable. And that's like my perfect situation. You make a comment, you make a comment often about just like, I want to buy and sell at the same time if I can, right? Because that's just like the stress-free approach. And how we do that is by making sure the sell side deal contract is structured properly. In most cases, you never know how the buyer is on the other side of the sell side deal, but usually you can work something out. You can arrange something that way, right?
Yeah. The key for you is to use your market data and your experience with the market to know, how do I time the sales cycle with the purchase cycle, right? And that's not a guarantee, but it's better than just trying to do research on the internet. You're going to know from being in it. And that's why the broker is so critical, because you're going to give them, okay, in this type of property, here's what's going on right now in the market. Mm-hmm. You also have a pulse in the market too. So if something change, you can adapt to that. And that's why I tell people, I say, if I was doing an exchange, I'd buy and sell at the same time. Managing both sales and purchase cycle is critical. You can't just do it and cross your fingers, right? Because we'll get into the timing of this, but yeah.
The clients that do this successfully are organized, prepared, they're on it, they're working with all of us together. This isn't just like from a client perspective, the way to be successful, you don't just like sit back, forget about that this is happening.
Yeah, right.
You lock in and you get this done. And usually, not always, but a lot of these guys we've dealt with are guys who have done real estate deals before or own a lot of real estate, et cetera. It doesn't have to be, but we've done deals with people who have never done this before or have owned one asset their whole life. So, but usually when you lock in and you identify and get it handled, it's the way to go.
I love analogies, right? So I use the analogy of playing dominoes, just lines up into play. Once you line those pieces up, it's in the setup that takes all the time, right? Just like in that game, right? But once you set it up, things fall into place. Even if things go sideways, you still have prepared for that.
Yep.
And that's where it's good to go. And that's how we work the deadlines, work the rules to your favor, not breaking them or changing them, because you don't have to. Just work it the way it's best way to work it. And you only know that if you know the rules. Yeah. Right? So, so I mean, to your point about the strategy side, that is so critical, especially in a hyper market either way. Yeah. A seller's market or a buyer's market. You have to be able to apply that because it does affect either way. That's why you can still do exchanges no matter what the market's doing.
Yep.
Okay.
And what my mom, who works with me, always says when we're like talking strategy around this type of stuff, even if it's not a 1031, but there's some kind of leap of faith that needs to be taken for whatever reason for a seller or a buyer. Typically, we're talking to sellers. So we typically say, when you make the decision to do something, when you decide and commit to something, I'd say 99% of the time, if you're in and locked in and ready to go and you've made that decision, while there's like some kind of leap of faith, as long as you've set up properly and structured everything right, this all gets done.
Yeah.
It all falls into place. Like you said, there might be some hiccups along the way, but we've kind of planned for those contingencies.
It's funny you say that too. The interesting thing about our business is, I said before, it's transactional and it's a volume. You need to do volume to make any money. And we'll talk about the fees and stuff. But what's interesting, the benefit of that is you see a lot of different scenarios, all different types of scenarios, and with us, a lot of different areas of the country. So it kind of gives you a sense of what best practices are. And to your point, it's really it becomes common sense once I share that with them. They're like, oh yeah, that's right. And I said, this is not me reading a book last weekend. This is watching how things flow. And you do these key things, just like success leaves clues, these different check boxes that you're doing along the way leads to smooth transitions. And it's funny, we've had exchanges, multi-millions, that go so effortlessly. And you would say, wait a minute, I only have 45 days to find someone, get into that. And yet others with small transactions struggle. So there's no rhyme or reason to the size of the transaction, how complicated it is or not. And there's no way to know that sometimes going into it, unless early on we're able to kind of talk ahead of time, like you said, in the strategy and preparation side.
Yeah.
That's where you alleviate a lot of the stress. We've had people, I had a guy sell 5 properties by 70, just to give an example. So you say, wait a minute, how am I going to do that in a short period of time? They're already in the business. They're already doing things that enable that to happen in sync with what they're already doing. So it's cool.
Yeah. The other thing I want to just circle back to is back to just usage. We talked about the primary residence. Let's talk about that a little bit more. So if you have a primary residence, you obviously get the IRS tax deduction.
It's
right?
exemption. Yeah.
Exemption.
Yeah.
That's the word. Okay.
Yeah.
If you own it for more than 2 years, right? I think is the rule or something.
And we don't specialize in this, but the rule is you claim it as your primary 2 out of the last 5 years.
2 out of the last 5. Cool.
Yeah.
Okay. So now what if you own it as your primary? You live in it for the first 2 years. You move out. You rent it for the next 2 years. You sell it year 5. Can you use the 1031 exchange alongside the IRS?
That is probably go either way.
Sure.
I would definitely have their CPA confirm that.
Sure.
But more of the recent usage would be the priority, right? Because that's the current usage at the time of sale. Could they technically use the primary residence exemption? Yes, I would think. But that's where we definitely bring the CPA in to make that call.
And either way, you have the 1031. So if you use 100% of the net, you defer the taxes.
Right.
But it's difference between deferring and...
It's that, and it's also the usage. The property they're going to buy, what are you going to do with it?
Exactly.
So if they're thinking,
have to buy an investment.
Yeah. Well, probably they use that as an investment, right?
Yep.
So they could say, well, we were kind of hoping to move into that. I go, don't do the 1031 on that. It's easy. Now you don't need the CPA. I'll just tell you now.
Yep.
But you still want to have that conversation anyway, because maybe, you know what, maybe we don't have to move into it, especially depending on the taxes, depending on the market, depending on what they want. They can find it. There's a bunch of variables there that'll kind of guide them. But at the end of the day, I tell them, it's really where you want to do with that property. Maybe they buy 2, one they live in, one they don't. Maybe they do exchange on partial. I mean, a lot of different ways to slice that, but it's still having that kind of a direct conversation with them and bringing the team in is critical.
Yeah.
Because I deal with people sometimes that like to push the envelope a little bit. And I tell them, we're not a governing body, a judging body, we're a facilitator, but be conservative, same fundamentals. Be conservative, dot the I's, cross the T's, and make sure that your team is up to speed. And usually the CPA goes along with what I tell them, usually.
Sure.
No, because it's not biased, it's not personal, it's not an angle. It's just straightforward. It is what it is. The numbers are what they are. The usage is what it is. In an audit, can you verify your usage? Like somebody use a property, let's say in the Keys or a vacation area, right down here, a lot on the coast or whatever. And they'll say, well, we use it sometimes. I'm like, well, okay. Well, if I pulled not me, but if an auditor pulled your tax return, what would it show? What would it tell them how you use that property?
Sure.
Number of times and all that. And I said, that tells the story. So it's really not something that's super subjective. But I would, again, I use the word conservative because dot I's, cross T's keeps you from having an issue. Definitely.
Let's talk about that, the secondary
Yeah.
home.
Yeah.
So again, it's back to usage, right? So how does that look for someone who owns a secondary home? Can they live in it, or can they use it part of the year, rent it part of the year? How does that work?
So good question. I mean, they can. There's a guideline now. Again, they always want to check in case the guidelines change. As long as they don't use it themselves more than 14 calendar days or 10% of the rental. So let's say they rented it for 300 days, they could use it for 30. I use that as an easy example because when I say, 10% of the rental period, they don't know what I mean. Well, it's days, right? So let's say, again, you used it for 300 or you rented it for 300 days, 30 days you could use it. Because really they want you to, you can have a dual usage, but you got to be primarily the one usage to qualify. You can't be split. Even let's say you lived in it 50% of the time and rented 50. You could make the argument, well, it is an investment because here's all the rental income. And especially if it's on an area where it's very high, high rental returns, they can show a lot of income on that. But the usage would disqualify it. That's
Understood.
the problem. And that's what they tell them. We're not going to look at, I've had people ask me to take a look at their tax return stuff. I'm like, I'm not going to do that. And I said, I'm complimented. Thank you for asking. I said, the trust that somebody would give me. I said, but let's get back to your CPA and I'll educate them if they need it. And then go from there. And usually the CPA is like pretty direct on it.
Sure.
Exactly.
They're taking the risk on some level.
Yeah,
right?
they won't do that.
Yeah.
Typically, right?
Yeah. So, okay, so we talked about flipping a little bit, but let's just say, okay, I bought this property. I'm going to flip it. I don't know. Something happens. We end up renting it. How would you think about that if somebody came to you and said that? And
so it goes back to the seasoning conversation.
Sure.
And the comfort of the CPA. And again, I'm not throwing it on the CPA, but they need to be part of this because they're looking at more than we are. They're looking at the whole picture of their whole tax return and their tax activities for that year, right? So if they just, let's say on an audit, God forbid they audit, the IRS would say, okay, Larry, when you bought this property, what was your intention? And
my intention was to flip it.
Okay, then they would say you're not doing the 1031. You're being exactly right. But if you have what we call intent to rent, right? They would say, okay, well, what would a landlord, so and this is the way my attorney explained to me over the years. So there's two paths you walk down, the investor path and the flipping path, or the dealer path. There's a couple different titles for it, same thing.
Yeah, flipper, dealer, right?
Right, it's just like a car dealer. Anybody that deals in assets, there's nothing wrong with that. That's your business model, right? But there's activities down each path that you take. The more activities you document down that path, the stronger the case is for that path, right? So I look at them as check boxes. So remember we talked about before, a year of ownership, check that box. 2 years, better, stronger checkbox. Show rental income. They don't mandate occupancy or rental rates. They're not going to say, hey, listen, as long as you rent it for X period of time, whatever. Because what if it's seasonal? I mean, they just want to show the activity. I said, I wouldn't rent it for $1.
Sure.
You know what I mean? Unless you have some weird municipality contract or something that rent it. I don't know, but that's not the case. So you want to make it look and feel like what a prudent investor would do. An investor needs to get that rented as fast as possible. You know that as an investor yourself. You don't want to let it sit vacant because that's your money right there, right? So what activities down that path of an investor would you do to check those boxes? And if you're not checking those boxes, they're going to be like, I don't know if I believe you. Even though you have documentation showing this or that, it might not hold up in an audit. Or the other side, if you, like I said, you're really flipping it and let's say it took you forever to rehab it because of supply chain issues and permitting and
sure, exactly.
a disaster came along, with a hurricane or something like that.
So you're a year deep. You're a year deep into the flip and now you're like, let me 1031 this.
Oh, exactly. Yeah. Let's play that out a second. Let's say that happens because we just had 2 major hurricanes come through and they had extensions as a result. So that means it impacted the market, right? So let's say your intent, you would never say my intent to sell because they would bounce it as soon as they looked at it. You would say my intent was, I thought selling it, but then I said, nah, we look like the market was going to be pretty strong. We want to rent it out, get some income before we do that. Rental income, consistent, using the property. And let's say we're a year into it. And now, because it's now taken longer than you estimated. Let me back up. Let's say you're going to flip it first.
Yeah.
Straight up. Let's say you're going to flip it. And now you estimated in our budget, time budget, money budget, financial turnaround budget, flipping, you need to move them. You can't let it sit there for a year. Now it took a year. Now you're out of budget. You're out of length of time. Now it's a financial hardship. Now maybe not bringing you down financially because you have a bunch of stuff going on, let's say. But now you change your intention to rent. Now you got to show intent to rent, as we call it. What would you do? Sign on the sign showing it's on the market for rent, put in the MLS for rent, social media marketing, whatever. And you get a tenant in there. That would be stronger. But if you just show intent to rent and then haven't shown any rental income, I don't know that I would do an exchange on that one. Because anybody could say, yeah, our intention was to rent. And you could bring the argument that says, and this might be okay. You could say, well, we were going to flip it, but it took us such a year to do that now I've got to sell it. Or maybe I was trying to rent it. I'm not sure. But because now it's a financial hardship, we have to sell it.
You just want to get it out.
I have to sell it. And I'm going to repurpose it. I'm going to reinvest it. So it's a gray area on that one to do an exchange or not. But if you have enough activities and your team is comfortable with it, defending that if questioned, then you do the exchange saying financial hardship, not a tax avoidance. It's a financial hardship. And we're over a year now, so it's now a long-term asset. We got to repurpose the money. I have to get there. Now, if you're a flipper, you're going to want to get in and flip it again, right? Because now you lost the use of that money that you're hoping maybe get it flipped in a 6-month or 3-month, whatever your time frame was. It would have to be a rental situation. Okay.
You want to sell that asset, 1031 it in this case, if everyone's cool with it on the team, and then buy a rental.
Yeah,
right? You don't want to buy something you're going to flip again.
Right. You can't say, and that's a good point. And I deal with this straight on. When I first was asked this question years ago, when they were flipping crazy back before the market crash, people were like, well, how long do I have to hold it before I can do the exchange? And they're like, I went to the IRS one time and I said, what's the answer? I'm not seeing anything here that documents a holding period, whatever. And the woman said this to me. It was the funniest thing ever. And that's where I got the concept. She said, Drew, you could buy a property at the beginning of the month, go through the motions, like I said, that path of what an investor would do. Sign on the market for rent, taking some rental applications, maybe you sign a deal, and then somebody knocks on your door and gives you a crazy offer for that. Way more income than you could make for renting in a couple of years. So now you're looking at the financial side of this and say, actually, I can make more money on the sale that I didn't expect. It was unsolicited, unintentional.
You've said that you've used that word unsolicited offer before,
correct.
Right? I've heard you say that.
And that's where it came from the IRS. When I talked to her, she said, you could change your intention at a month of ownership. So I ran that back to my attorney right after that. I'm like, you got to be kidding me. This is unbelievable. And his comment to me was classic. He said, technically, yes, you could do an exchange in that scenario on a one-off scenario, owning it 1 month. He said, but I would document the living you-know-what out of that and make it extremely one-off, and I would not do another one that year. Like if it's a one-off, it's got to be a one-off.
Yeah.
And you're also taking the risk that they don't believe you.
Every month you're getting unsolicited offers and 1031ing. That
exactly
doesn't work, right?
Yeah, well, hey, it all legitimate. Here's all my documentation. Yeah. I have my broker showing me the numbers.
Not cool.
But exactly. So, but in that case, we've had a situation where a guy bought a property and could not rent it for 6 months. And he didn't have a lot of properties. Now this is definitely financial hardship. He can't carry that property. He wasn't buying it to carry it. It was supposed to carry him, or at least its own self, right? In that case, we did an exchange one time. They owned it 6 months.
Okay.
CPA was on board and the realtor was on board because the realtor said, yes, here's all the proof of us trying to rent this.
Here's the MLS listing.
Exactly.
With the rental.
We're not getting it.
Yep.
In that time, maybe the market shifted at that moment. Something happened. That's why the broker critical, because you're pulsing the market, right? And then we sold it and we repurposed the money. So it was a problem solved, not tax avoidance.
Last comment on usage, and then I have some more interesting questions for you or scenarios for you later.
Right.
But land, let's just talk about land. How does that work? How should I think about if I'm investing in land?
So great
I'm not
question.
Rent it probably.
Right.
In some
land,
cases.
unless it's agricultural, you might not be able to rent it out, let's say, right? And let's say you can't rent it. You're holding it for a future investment use. What that means? Well, it depends on you. Maybe you're going to develop it. Maybe you're going to hold it to sell to a developer. All right. The key is that you're not selling it as a flip, number one. And number two, you don't want to become a dealer. In other words, you don't want to say, and this is where it can be gray area as well, but again, having the team will get you through it. Let's say you bought a property and you want to develop it and maybe put a rental in there, okay, as a rental property on your own, because you can. That's the most cost effective. You have to be patient with the time and all that, but buying it wholesale like that and building your own house, right? Whatever. And let's say it takes you a year or two to build it. And now you're like, man, I just want to sell it. I don't want to rent it now because I got to get that money back. It took me longer, whatever. Little bit of a gray area because are you a dealer? But you're not an investor because you didn't rent it out. So I would tell somebody if that was the case, I would try to get some rental income there. Because if you're going with the path, down that path of an investor makes their money by renting it. They need to use the property to make money. They're not trying to get rid of it. It's an asset that they're using to produce income. So why would you get rid of it, right? So that's how the IRS looks at it. It's not that flipping's bad. It's not. There's nothing wrong with it. But if you have to sell it to make money versus I need to hold on to it to make money because that's my rental income every month. Why would you get rid of it so fast? So that's how they look at it, right? That's why they tend to be a longer hold than anything else. So if you had it in that case, let's say it took a year or two to build it. Let's say it's a bigger property, whatever, commercial, residential, doesn't matter. But you never rented it. I don't know that I would do an exchange on that. I mean, not saying we haven't. Probably in the past, somebody had a one-off scenario. But that's with caveats and the team conversations. And I tell them, listen, it's not our job to be to be a judgment on what you're doing or pass judgment or anything like that at all. We're educational. That's it. I'm educational, give you as much option as possible, but I don't want you to do something without being, eyes wide open going into that, what could happen, and have your team check those boxes. And that's where I think it's necessary to have those conversations, even when you're in a gray area situation.
Sure.
Sometimes things are going to be gray. To you said, have the confidence and the faith in your team to do it. You're not trying to get over on the government or IRS or something like that. You feel legitimately that this checks the boxes and you can defend it with these XYZ activities. I say go for it, because that's what it's all about. It's not just some situations are definitely cut and dry, without a doubt. But there's some cases where they're not. Things happen. And I said, you have to do your best guess of the facts at the time. And your activities document that, and that's where we're at.
So if you buy just a piece of land, you don't do anything to it, you just hold it, and you hold it for a year, 2 years, and you want to 1031 that.
You could do that.
You feel good about that.
Yeah, I feel good about that because there's some time now.
Yep.
And the land is definitely, like I said, could go a lot of different directions. But
sure,
you might be. Example. Let's say you find out there's an Amazon distribution facility going to go on, so you buy that land up, and you're going to hold on to it because they might need that land.
Yeah,
that's a great investment. Right? You buy it cheap because nobody knew or you didn't know maybe. And out of the blue, Amazon announced they're going to put a big facility there and your value just went up. Yeah. That's a great investment that works for a 1031 all day long.
Okay.
Yeah.
That's cool. And we'll touch more. I have some thoughts, questions on the construction piece, right? Buy this land.
Yeah.
Do construction on
sure.
1031 and or 1031 into that, right? We can talk
sure.
about that too. I know there's some little tricks there or tricks, whatever you want to call it, strategies.
Yeah, strategies, yeah.
So let's just talk about the overall benefits of doing a 1031 exchange. And I know people are probably watching this like, what is the actual mechanics of it? We're going to get into the mechanics here. But I think just overall, what would you say? I know you typically list off a ton of benefits. I can probably think of a few right now. What would you say generally benefits of a 1031 exchange are?
So great question. There's tax benefits and their business development and protection and multi-generational wealth building benefits. That's a big one, right? Yep. So the easy one is, as you mentioned before, indefinite and unlimited tax deferral. That's a given for your whole life. You never have to pay the tax, right? If you ever sell, you have to pay, but then you pay back whatever you didn't pay at the time. That's first. Unlimited, indefinite. Second could be cash flow. Take land which is not producing cash, buy something that is. So you create cash flow that you didn't have before. And with that, you add a couple other benefits. You have the depreciation credits you get. So every year you depreciate the value of the asset, whether it's 27 and a half years or 39, depending it's commercial, residential. It gives you a tax credit that gives you a less tax bill every year, right? So you have the cash flow, you have the credit for that, for depreciation. You have the appreciation. Now they tend to appreciate faster if it's improved, right? Not all cases, but it does. And the time value of money. Those are the four. So the cash flow is that with all those different subcomponents to the cash flow. You could be other things like diversification. Okay. I don't want all my eggs in one basket. What if something happens to that property and I'm relying on this property for my income, whatever the reason is. So I want to diversify. I want to have in multiple properties or multiple different types of properties because that way if something happens to one, I'm still okay.
Yeah. Or multiple locations, right?
Exactly right.
Yep.
And the opposite is also true. in my classes, I'll say, which one's better, diversification or consolidation, right? Some people say, well, diversification, yes, in case something happens. What if you don't want to manage properties all over the place? What if you're a one-person operator? You want to manage things yourself. You're a very hands-on person. There's nothing wrong with that. Well, if I have 4 properties, let's just say, all over the city or in different areas, and I have a problem in this property and a problem in that property, I'm going to drive myself nuts. So I want to consolidate.
If you consolidate and or just have properties all over a specific area versus owning stuff, say, in Boca Raton and then owning stuff in Georgia, you have multiple managers. You don't have the scale or the ability to execute as well in a specific area. It makes you smarter in that area because you have more data points on rent and everything else, right? And cost of labor. So there's value to being consolidated to an area. There's value to be consolidated to one building, period, right? And I get the diversification piece as well. There's value to that too. So
if you're consolidating it, the easy one, there's multiple ways of doing it, like you said. But let's say I don't want 4 properties, I consolidate to one higher density one. That's an easier management thing. So those are a couple of the other benefits. The other benefit would be leverage, right? So let's say I have a $300,000 condo, no debt on it, and I'm having a tough time making the cash flow because the condo fees or the rental, whatever it is, and maybe they have restrictions on rental. You can only rental so much. Some people might want to get into a short-term rental scenario, whatever. Maybe you want to repurpose that money. Take that 300 cash, let's say you net that, and put it down on $1 million property. Again, just use the numbers easy. $1 million property will tend to produce more income. Might be easier managed, might be not. Depends on the situation. Might be no management. It's a triple net or something like that. So then you can get that and get out of where you're at, and you use leverage to get there. The $700,000 loan, the property's going to pay for it, or else you won't do it, right? So you're using leverage in a positive way to get you to the next level.
I'll give you an example of that too. Here in Boca, we have a handful of duplexes, and what we found is owning these duplexes in Boca, while they're worth a lot of money, so we have a lot of equity in the deal. If we levered that up to, say, the 75% LTV mark on current values, we wouldn't cash flow, right? So we've found, because values in Boca are just so high, right? And which is great. We call them pieces of gold. Each of our duplexes are little pieces of gold for us, right?
Exactly.
And that's because they hold value well. They're worth a lot, but the cash flow on them really isn't as grand as you might be able to get, or as good as you might be able to get in other areas. So if you're looking for cash flow, you might go to, as an example, Lake Worth. And so you might 1031 your duplexes because you can sell them for so much money and then go ahead and buy stuff that cash flows real efficiently at 75% leverage. So now your usage of money, your usage of capital, or call it your ROI or your net yield on cost, all those numbers go higher, right? Because you've repositioned your money and you're using it more efficiently. So if you're thinking of it from that perspective and that's your strategy, cool. If you want little pieces of gold in Boca, that's also cool, right?
Yeah, because you never know. That brings up another one that's a benefit called estate planning, right? So let's say you're happy with that piece of gold scenario, right? Because you want to stay there.
Yeah,
and you don't need to go more.
Great neighborhood, great market, super easy to manage.
And you want to pass these properties to your heirs, right? That's where, over a lifetime of owning that, they could continue to raise or whatever they do, right? But they're also paying the income every month, right? And let's say you depreciate them out. Well, you're not going to sell them. You decide, let's say you're not going to sell them. Pass them to your heirs. Your heirs receive them at the current value. They do an appraisal of the property at that time. That becomes what their cost is now. So let's say your cost was 100, they're worth $1 million. They inherited at $1 million. That becomes their starting cost. So they turn around and sell them, they have no gains. It wipes the gains out, right? Now there's limitations to how you set up your estate structure and all that. I think it might be up to 11 million in assets or something like that. But the point is, gets them thinking about passing that baton forward, where they can continue to do that. If they don't want to change anything, that's fine. But it'll benefit the second generation. Now these pieces of gold go to the next generation. And they don't have to sit there and develop it or establish it's already there. So that's where I said before about that multi-generational aspect is really powerful. I mean, if you think about down the road, now I'll have some people say to me, sometimes I bring it up and they go, my kids don't deserve any of my stuff. I've had somebody say that to me. And I didn't even bring up any of the family stuff. We weren't talking about our personal lives or anything like that. And it got real cold for a second. I was like, whoa, Where'd that come from? I didn't read that at all into the conversation. But when somebody said that to me, and I said, well, okay, maybe they don't deserve it. How about somebody else? Nobody. Okay. So then I said, well, still preserve it because you still need the gold throughout your whole life, don't you? Doesn't matter your age. Why sell it to pay a tax that you don't have to pay? Just let it run and give the properties to whoever you do at the end of your life. It's not a have to scenario. You still need cash flow. You still need gold at any age of your life. Last time I checked, why kill that golden goose there? You don't have to.
And so that's why I haven't 1031'd those assets. We've made
Right.
the decision because I sit between, some people say I take risk, and some my friends that have, corporate jobs that live like very conservatively, they would say, and a lot of engineers typically are very conservative. So a handful of my friends
Right.
are engineers, and they work for, I don't know, General Electric and all these other big corporations. And so they'd say, Larry, you're definitely you're not risk adverse. You'll go do it, right? And I don't actually believe that. I actually believe that I'm relatively conservative, and this is an example of that. That's why I haven't 1031'd those. And the moment that I will 1031 those is probably when I find the big asset that is a really good deal. And because I know I can sell these BOCA assets pretty quickly. I'm also a residential real estate broker, and these are single family homes and duplexes, so easy for me to move. I know I can sell them. I might put said big deal under contract and then just go handle the BOCA assets if I need the cash to go do it, and I'll do that 1031. And it almost might be a reverse. It might be just a perfect timing type deal, right? But that's why I haven't sold them, just for that single reason only. Hey, I can maximize my leverage, which is one of the other comments about just benefits around 1031ing, and that's basically what I touched on there. So that's why I haven't done it, because I think I have moments of let's take the risk, and then moments of let's be conservative, right?
Well, it's funny you say that. I tell people, it's very similar to what I tell people. I said, you don't sell the property to save the tax. Okay.
There you go.
You sell the property because it's not working for you. Not necessarily negative. It's just not working right now, or you want something to work better.
Yep.
So I tell them, you're at A, you're trying to get to B. Tell me what B looks like for you. Where are we at with that? Because obviously you've already decided to make the sale, or maybe you're on the fence. We have a guy, I just spoke with one of our clients up in New York, and he was the last to sell. And he wasn't looking to sell. He gave a crazy number and he got it. One of those things. And now he's like, now I got to figure out what to do with it. And I said to him, I go, you're kind of in the driver's seat because you don't have a rush to closing date. You have time to do strategies and set it up correctly. And you got what you wanted. He goes, I should have asked for more. I go, maybe they took the offer too fast. But it was already more than he thought he could get. But my point is, you're selling it because you got an offer that worked for you. For whatever reason, doesn't really matter, right? But let's get to this guy and girl over here. Whatever these other properties are, they're going to do better than this one. And now that we've had 2 conversations already, and the first conversation is really like timid, like a lot of times they start. We had a conversation yesterday, and he's like getting more pumped now. I'm like, that's what you want. That's why he's the monopoly analogy. Let's play the game for real, man. Let's have fun with this thing. I mean, you're moving things around to strengthen whatever that means to you. And it could be estate plan. It could be structure. It could be getting out of a partnership. We can talk about that.
Yeah.
That's a common thing we run into all the time. But there's a means to an end. This is here. We got to get here. And the more time we get ahead of time, the more options we can come up with to help you plan for that, basically.
Yeah, the estate planning piece is important. Sometimes people leave that out. So you want to, when you're thinking about all this or just planning generally, you want to include that estate planning.
Yeah, and piece. That to kind of sum up the benefits, exactly. I mean, the benefits are really about what it means to the client. What do they want to get out of this? Saving the tax, believe it or not, I don't want to say it's secondary because it's pretty important, but it's not the primary focus. It's a motivator to stay engaged and to really make this happen because I don't want to pay that. And some people say to me, I already pay too much taxes, whatever. They get real emotional about it. I'm like, well, if you make money in this country, you kind of have to pay tax. I mean, it's kind of this.
Sometimes that's a good signal that you're paying taxes, right?
Exactly right.
That's how I like to think about it.
Right,
at least.
exactly. Like you made money, that's why you have to pay. But the point is, you don't have to pay more than you have to, number one. And number two, let's focus on what it means to you. And these benefits come as a result of that. And the majority of our conversations are on just investment strategies, just like you were just talking about with your situation. That's classic of what happens because the taxes, we'll cover that. by doing what we want to do, what we need to do, or what we want to do with this whole next steps. And that's the fun part for them too. And by the end of those calls, they usually are pretty, like I said, pumped, and they're specific now. They go, okay, well, let's get going, Larry. We got to do whatever. And that's where we want them to be. I don't want them to think the negative, because sometimes you bring up the IRS and taxes and people are like, oh, it's too much complication. They're going to have to pay it anyway. I'll just pay the taxes. I'm like, not so fast. I mean, I had a situation one time with a CPA who said to the client, you're going to have to pay them anyway. It's never going to be lower. It's pretty low now. Just pay it. And my conversation with the client was, and you got to be very careful how you structure this. And because I've done this for so often, I knew how to handle it, because I don't want to throw the CPA under the bus, because that is a correct statement. It could go up, right? He's not saying something wrong to her. But I brought her back to the same thing we were talking about is let's play it out a second. When you sell this asset, now it stops producing for you, okay? At the time you sell, no more rental income, no appreciation, no depreciation, no cash flow, nothing. So then you're going to repurpose it over here. You're going to put it somewhere. You're not going to put it in the bank at a couple of points, right? You're going to repurpose that. You want that money to stay working for you. So if that's the case and you want to do that, why would you pay any taxes then? Okay, he's correct. But at the same time, it doesn't address what you're going to do with those funds. Now, once that money's used up, it's gone forever now. It's not working for you anymore. And she was like, yeah, you're right. And I go, well, I'm just giving what you gave me that you wanted to do that. And that's the power of it. And so the CPA came around and said, yeah, you're right. So I don't want to lose the CPA in that conversation either, because we need the CPA. But I want to bring them to the idea that there's other ways of thinking about this that are beyond a CPA's world.
Yeah, like talk to your financial planner, right? Like include your financial planner in on this plan.
Exactly.
For sure. I mean, one of our mutual clients that we've worked with, he has a family office, which is just all encompassing, right? That's everything in-house, right? So that's an efficient conversation when you talk to John, the lead of the family office. You just quickly kind of encompass everything, or we have a conversation with John, and John's like, I need to talk to said person in-house to make sure this lines up with what we're thinking makes sense right now, right? So again, he will talk to all these individuals, right? So,
yeah, and the nice thing is it's getting everybody up to speed with what their role is too. Here's what you need from this person or this group, right? And if it's a family situation, maybe there's some structures of either anonymity or passing on, like a life estate scenario or a trust scenario or something like that, where they need to incorporate that or want to incorporate it now. So we talk about how that impacts the exchange as well. Or maybe you don't do it now. Maybe you do it after something.
Yeah.
Right? So
yeah. So now I think I want to cover just some key terms that we typically use and throw around. So let's start with, I think we've maybe mentioned this once or twice already in the conversation, basis. What does that mean? How do you define basis?
That's a great question. So anytime you sell anything, you want to know what your real cost is, and you want to know what your net sale is to figure out how much money you made, right? So the way they define that is use the term cost basis, which means your true cost at the time of sale. So that's one of the fundamental questions we ask them to ask their CPA is, okay, I bought it for 200, sold it for 400. I made 200, right? Not so fast. Maybe. But if you bought it for 200, what did you do while you owned it? Did you do any capital improvements? Well, that raises. That's more added to the 200. Yep. So maybe you have 50,000. Now it's 250 is your cost.
Put a roof on.
Put a roof on it. The capital improvements, right? Anything big stuff like that.
Yep.
But then depreciation affects that as well. Goes down. So you got to look at where that is at the time of sale. It's not as simple. It's simple, but it's not as simple. You saying I bought it for 2, sold it for 4.
Now,
right?
when you say depreciation affects that, so you're doing a straight line depreciation. Your accountant's doing this, right? Every year. And so they're deducting some of that.
The value of it. Yeah. And that's why you need to know what that real number is. And it's not a prerequisite to give to us or to know the numbers before you do the exchange. It's not. But it's a value to knowing the value of the exchange and why you're doing it as a secondary or another benefit beyond the other benefits we talked about.
Know the value of the exchange, right?
Exactly right.
And it's very hard to know the value of the exchange if you don't understand what your net is going to be.
Your real cost.
Your real
so
cost.
So if you look at so if you look at what we talked about in the beginning, your net sale price is what you really net. Normal cash you put in your pocket. So that's a number. And then once you have your real cost, which is cost basis, you subtract, there's your difference. That's your gain, right? So in that case, people think of it as your profit. That's a layman's terms. It's really not profit, it's gain, but similar concept. I made X dollars selling this property. And you don't want to guess on that, I tell people, because you could be off. What if you didn't capture something that your accountant captured?
So, okay, so the profit is your net minus your basis? Okay.
Exactly
but
right.
the profit doesn't affect the new purchase you need to make in a 1031. It's your net.
Right. So it's funny
right?
to say that. So there's two sets of calculations,
Yep.
right? The calculations are what your taxes are. So there's three fundamental questions we ask them to ask CPA. First, what's your cost basis time of sale? Doesn't move every month, but every year it could change. That's your net cost, right? Second question is what is our gains and the taxes on the gains, right? So that gain is that difference, net sale, net cost. That's your gain. And then if you're in a state that has a gains tax, you want to know the state gains tax too. So federal, we covered 15 or 20 if you owned it more than a year. A state could be as high as 9, some states or more. Some states is 5 or 3 or something like that. Just know what it is. Florida doesn't have one, so if it's in Florida, it doesn't have that. That's the second question. The third question is, what is your depreciation recapture tax? Now, this one, most people don't even know exists.
Yep.
Until they sell.
And this is what I was touching on the depreciation piece
so
earlier.
Every year you take, let's say it's 27 and a half years, if it's residential, you take a 1/27th-ish of the value every year, and that's what your tax credit is, right?
You got to add that back.
What happens is when you sell it, the IRS says, wait a minute, that's not a freebie. Add up all those credits. We want 25% of all of it back. So you say to yourself, whoa, where did that come from, right? Well, that's the way it is. So those are the two taxes that are fundamentally what we deal with every day, right? When they do that. Now, if it's land, they don't have depreciation, but they have the gain. And they usually have a lot of costs. Usually the cost is the cost with that. But they want to know what the numbers are, to know what the savings are, right?
And your basis includes all of that you just talked about right there.
Yeah, it's all calculated in. So you're taxed on the gain and what you depreciated, right? Now, the other part of it is when you do the exchange, you say, okay, now what is my calculation to spend to not pay those taxes? That's your net sale price. Very simple. Now, a couple of things I want to cover with that. So back to what we said before. Let's say your net is $1 million, but you have a $500,000 mortgage. You only have $500,000 cash goes into the exchange account, but you still have to spend $1 million. People say, well, wait a minute, that's not fair because that's the bank's money. I said, well, you used the bank's money to get where you were. It got all the financial benefits of the cash flow, the appreciation, all depreciation got you there. Okay. You're still responsible for that, even though it's bank's money, but you would get a new mortgage to offset that or seller financing or add cash or you pay tax on it.
Let me understand that.
Yeah.
So how do you get into that situation? Let's use an example, maybe just a simple one. If you buy a property for $1 million and then so $1 million cash, then later you put some debt on that, $500,000. And then you go to sell this to 1031 exchange it at some point. Your net is $1 million.
Your net is your net.
Yeah.
Right.
Even though you've already taken that $500K back and you spent it or did whatever you did with that, your net still $1 million.
Exactly.
And
what's funny is I'm glad you brought that up because we run into this every week, multiple times, multiple days. So here's how it is. So you can't finance your way out of a tax bill. You can't pull equity out of a property and magically reduce your tax consequence. It doesn't work. They're similar, but they're not the same. So it's always the net sale price. That's what they figure tax against. That's what you got to spend to not pay the tax.
Yep.
Right? So if let's take two scenarios. Let's say you and I sell $1 million property. You have a $500,000 mortgage on yours. I have nothing on mine. Why would we pay two different taxes? Just because you took money out?
Yeah.
The IRS can be like, that doesn't matter. We still have the gain is the gain.
Yeah.
Right? Now that could go against you if when the market dropped last time. We had somebody who borrowed a big amount percentage-wise, and then their value dropped. So the value of the property dropped, and then they had no equity, but they still had a tax bill. So imagine that scenario for a second. That was pretty difficult.
So if you have money, like money outside of the deal, you can solve that by putting more money into the deal, right?
Yep.
Like that solves it.
Yep.
Now, not everybody has that situation.
Or wants to do that.
Or wants to do it.
Yeah.
So you can still defer 100% of the gain by simply just putting more money into the deal. So say
Correct.
your net is $1 million, you got to spend $1 million, but actually what you're getting in your pocket is $500,000. You can show up and buy another $1 million property with $1 million cash.
Yeah, you
right?
would add that $500,000 to the exchange account to make it whole. And we'll talk of the logistics next step. But you brought up a really good point. So the financial structure is set up by what the sale is at the time of sale. Okay, you want to figure out, well, as I said before, those three questions of what the taxes would be. That's what you're fighting for. Now, what's interesting is you also want to know that because once you complete the exchange, the financials of the property you sold get transferred to the one you buy. So let's run that scenario. Let's say on that $1 million, take the mortgage out for a second. Let's say you sell for a net $1 million, and let's say your cost was $200,000. Cost basis time of sale. And let's say you bought another property exactly at $1 million, even though it's not going to line up, as we mentioned. But for conversation, just get the concept. Let's say sell for $1 million, buy for $1 million, you're good to go. Exchange over, no money in the pocket, 100% deferral of those two taxes, right? The new property, even though you paid $1 million for it, inherited the cost basis of $200,000. So if you turn around and sell it the next day, you have an $800,000 gain there. That's the rollover effect. All the financials transfer to the new property, right? Including the depreciation schedule. So let's say you're 10 years into the depreciation schedule. The new property is 10 years into the schedule. It doesn't start a new one. It just continues. That's that rollover, that 401k thing. It just keeps rolling and rolling and rolling. Now, let's run another scenario. Let's say you buy something at $1.5 million. Now you have additional $500,000 that you brought in, let's say, cash or debt, doesn't matter. Now you have additional costs. So on that $1.5 million, that $200,000 cost base you had $500,000 to it. So now you have a $700,000 cost on that $1.5 million, right?
Sure.
And a new depreciation schedule on that extra $500,000. So you see how this can start getting really, really involved? Mm-hmm. That's why we want Mr. and Miss CPA involved.
Yeah. Yeah.
Okay, because I've had people say, well, I do my own taxes. That's fine. I say to them, but now we're starting to graduate into more advanced stuff. Can't hurt to have another set of eyes and ears looking at what you're doing. Again, their call. But see, this is the kind of things I'm watching out for them on. Just got to give them a heads up because they might not realize these things down the road.
Yeah.
Yeah.
And what you're talking about, I have some experience in because you and I talked about this when I was buying this asset. We bought a deal really cheap, got really lucky. Bought a deal. I'll give the exact numbers. Bought something for $370. It appraised at $800.
Sweet.
Okay, so just super fortunate circumstance. Again, if you do this enough, sometimes you get lucky. And so we invested some cash into it. So we actually only put $30,000 in it. So our basis, $400,000 plus closing costs, whatever, right? Okay, so we knew this, and then we refied it. We did all this cash, and then we did a cash out refi on it, right? And this is the only deal I've ever done where I was able to refi this quick too. We did it in 6 months, right? So we were talking to you at this time. We're like, hey, we might want to 1031 this at some point in the future. Right now, we're gonna rent it, but at some point, these BOCA assets might end up in this situation, as we just discussed. This was a BOCA asset too, and so we took cash out at $450,000. So we have $450,000 of a loan on the property. So now we were asking you, okay, so if we 1031 this, how does this work? Because our basis, just call it, our basis is going to be
300. That's it.
300, whatever
400,
number, 400.
Yeah, 400.
So you would say 400, and we have a loan of 450, right? So if we 1031 this, what's that going to look like? And I think, tell me if I'm wrong, the conclusion there if we want to get 100% of the gain deferred, we're going to have to come out of pocket, call it that $50K to make that 100% deferred.
Right. If you sell it, let's say 800, 450 gets paid off. You get a new mortgage at 450 and use the difference to get to 800. That's the case. So,
because we bought it all cash. So actually,
but at the time of sale, you had a 450 mortgage.
Yep.
So you're going to have to replace that.
So I'm going to have to replace the full, say the net is 800, right? Just call it the net. Forget the mortgage, right? Just the net because.
So that 350 cash goes in the exchange account. Now you have 350 put down on 800 purchase-ish. That's the key. So sometimes that becomes an issue, especially if somebody doesn't want any more mortgages to have a mortgage on the purchase. Sometimes that would stop a 1031 from happening.
Sure.
Because of the structure. But those are the kind of things we walk through it. Now, the other part of that would be, let's say in your scenario, let's say it was a smaller loan. Let's say it's 50-50. Let's say you have $400,000 loan, $800,000 sale, and you decided to use 300 cash. leave 100 in the exchange and maximize the loan amount. Similar to what we said before, that means that 100,000 left in the exchange account would be taxable. So we tell them when you're working with a lender, make sure you give them your cash and debt numbers, what you have to spend. How you divide them up on properties, as we said before, doesn't matter.
Yep.
But you don't want to leave cash in the account because then it's taxable. So we've had a situation one time where the lender maxed out the loan and left some money in the exchange account, and they spent more than they spent enough to use the exchange up, and they had some tax coming up, and they were not happy.
Wow.
So we usually don't run into that. In fact, we're very proactive, and we can't really get that deep into the transaction. We're not really allowed to do that per se, as far as be their consultant or their advisor. But if from a structure standpoint, I want to educate them and let them know that that's what's going to happen. So we've been even more proactive telling people, listen, if you run into that, just make sure you tell your lender these things, because we don't want to into that awkward situation at closing that we have money left in the account and they find out they have to pay tax on it.
Sure.
Then they're mad at everybody.
Yeah.
And it's not really fair, because we did discuss it and we tell them that. But not one case have we had an issue where they were upset with us, that's for sure, because we covered it. But it's not even that. I just don't want them to run into that. And usually they don't. Usually they don't, because we're like an active conversation.
And that's the point, active conversation. Like I was talking to you about this when I was refinancing that property. So
you're proactive,
2
which
years
is awesome.
in advance of whenever we might do this, right? As an example, if it's seasoned. So yeah, okay.
That's the key, because and you bring up a good point there too. I tell people, if you're thinking of selling or thinking of buying, that's an investment. Never too early to have a conversation with that. Even if it's not going to happen right away, because there could be things you're doing that could mess it up. Can we talk about ownership, breaking up partnerships and stuff? Is this a good time?
Let's do it.
So let's say, because we run into this every single week, common ownership structure is you own a property in an LLC and you have two or more members. Let's say it's, to keep it simple, two partners.
So this is my exact situation on a handful of my deals. I have a close friend and business partner, and we've been buying stuff. So,
right. So let's say, and again, this is not relative to yours, but similar situation. Let's say you and your partner decide that we're going to separate after a closing. We got together to make this happen. For whatever reason, doesn't matter. We're going to separate. I'm going to take my money in one way. He or she's going to take their money on the other side. Okay. So back to the structure of 1031s. Remember I said the taxpayer can take advantage of this. Well, the taxpayer is whoever is the seller at time of sale. If it's an LLC on title and it has two members, doesn't matter the number, but two members or more, it's a standalone tax entity that files a tax return. So in effect, even though there's two owners, there's one taxpayer. So at the time of sale, that's the taxpayer. So if that taxpayer wants to get a deferral of their taxes, that taxpayer has to do the exchange. Well, if they're separating, they're in effect dissolving the LLC at the time of sale. The taxpayer is not available to do the exchange. So it kills the exchange before you have a chance to do it. So there's a couple ways of looking at that, and it can get super complicated, but just give you the concept very easy. First option is maybe 2 years, hopefully, before you decide to sell. Most of them never do this ahead of time like that.
Sure. Yeah.
Because nobody's thinking like that, and you don't know to think that anyway, because you don't know about the exchange. Just think, all right, when we sell, we'll just do an exchange. The common thing is I'll take my side, they'll take their side, and we'll go. It doesn't work for the exchange, though. So if you can, two options. First option is you have an agreement to say, you know what, this property, when it gets a certain target or whatever, we're going to sell it. We're going to go on title as individuals, or maybe our own LLC, single member for Larry, single member for partner, whatever the scenario. And then so at that point, you transfer your membership interest in an LLC for a title interest in the property. Now the title has two names on it. Could be two LLCs, two individuals, doesn't matter, but two taxpayers. Now you season it, remember the seasoning, you season that for 2 years. So now you have two tax returns with these new owners. They were the same owners, but different taxpayers now, right? And then you sell it, you take your side, they take their side, no problem. Easy. Do an exchange or not an exchange, or you both do an exchange separately, doesn't matter. But you have flexibility, maximum. But none of them are set up like that.
Yeah.
But I'm saying that for the audience, if somebody knows that now, maybe think ahead of time to set that up, because that's the easiest. Let's say you didn't know that, which again is the majority of them. So the option is this, is that, okay, let's say we got it. So a couple of caveats. We have to keep the LLC intact because it's the taxpayer. It has to start the exchange and finish the exchange to get the tax deferment, even though it rolls individually. Okay. So we're going to put a management agreement together. It's an idea, management agreement together that says because the taxes due, whatever, we're going to have the LLC do the exchange, and we're going to direct the LLC to buy properties on our behalf. So whatever properties I want to buy, one or more, doesn't matter. With my side of it, 50%, let's say, it doesn't matter, it could be whatever percentage. I'm going to have the LLC buy these properties with my percentage, and my partner is going to have the LLC buy those properties with their percentage. But the agreement comes back and says that I'm going to, beginning the separation, I'm going to have all the benefits and risk of the properties that the LLC bought for me, and I'll get the K1s on that. Same thing with my partner. So if I lose money, I can't go to my partner because my decision, we're going into it up front. Or if they lose money, they can't come to me. Let's say they made a bad decision, whatever. And then you let it season for, again, 1, preferably 2 years. And at that point, then you trade your membership interest for a title interest. Okay? Because doing it before then doesn't give the seasoning, and it could blow it up.
So you still have to wait, technically.
We recommend it.
Yeah.
An attorney brought that scenario up to us years ago. Because we kept running into it. And they said, well, what if we did this? We said, it looks good to us, right? Type thing. And it takes discipline too, because if they're not getting along,
oh, totally. It
might be a problem. But we've done one with a partnership with ex-spouses, actually. And they were able to do it because they were getting along. The bigger picture was what was served about saving the taxes, and they weren't going to affect each other anyway. I mean, it was a little bit, at first, I didn't think it was going to fly, but then they said, no, we're good. And it could work. What we recommend not doing is what's called a drop and swap. You've heard of that one before, but anybody who hasn't heard this in the audience.
Yeah, go through it.
That's where you actually, same scenario, and you're closing, let's say in a month or quick, you realize about the 1031, you're closing a month or whatever, short period of time. And you say, well, I'll tell you what we're going to do. We're going to have attorney drop up documents, and we're going to change our membership interest, go on title now. And then when we sell in a month, we're good to go, right? Except for one factor. How long have you owned the property in that scenario? 1 month? You didn't have time to season it. And that's our word, seasoning, please. That's not a technical definition, but it kind of explains what's really going on there. And that's the difference, is that you could definitely do that, and people do it, okay? We have a scenario now where somebody wants to do it because the partners really are not getting along, and they have to do it. And I informed them up front that the risk that we believe it's not going to fly. Why? Because God forbid you get audited. The auditor will say, yes, the LLC, as the taxpayer, might have owned it 20 years, right? Definitely no problem. But they have new taxpayers that just took ownership a month or two or whatever short period of time right before closing. It'll look like it's a flip to them.
And that's all contractually, right? You're not actually filing a new deed or anything with the county or anything. So
no,
this
you
is
don't
a
want
contract.
to file that. No.
Yeah, so this is a contract.
It's an operational, it's an additional contract, a management.
Operation agreement.
Right, adds to the management adds to the operation
LLC.
agreement.
Yep.
Exactly right.
Yep.
How they're going to internally work together from this point forward in that scenario.
And that's typically notarized and signed, so like you can't like backdate it or do any of this sneaky stuff.
I would, and that's usually if we're involved, that means they haven't closed yet.
Yep.
So there's no reason to do any of that. It's just now that we know this, I run with the partners. Here's the concept. Is that going to work or not? It doesn't affect us.
But they still have to season it.
We recommend it.
Yeah.
Again,
so if they're under contract to close in a month, this doesn't work still.
I mean, how could we still do the exchange? Yes.
Sure.
We're not we're a facilitator. We're not passing judgment on anybody. Okay. We're not filing things. We're not reporting things. It's not our role. But out of fairness to taking care, as we said before about clients, I'm always going to say something.
Yeah.
There's not a time when I haven't said something.
It's pretty gray. Yeah.
And I tell them, here's why we don't recommend it. I tell them straight up. And I'm not trying to kill their deal either. But I don't want them to do it. And down the road, the IRS looks at it and says, you flipped the property. Larry, you owned it for a month. No, but the LLC owned it for 20 years. Great, but you owned it a month. How do you prove you used it as an investment in 1 month? Well, here's the rental income. Yeah, but it's 1 month. Now, we don't agree with that, okay? I think it should be fine because it's very close ownership. You know, it's the same, similar owners. It's the same thing. They're trying to make it happen. But that's not how they look at it. Unless they've changed their mind, but some people are willing to take that risk, that's on them.
Sure. Okay. We kind of covered a handful of the terms. We talked about, let's see, anything else here. Let's talk about boot and mortgage boot. When is that term used? And
so it's funny you say boot. I usually try to reverse engineer, to use an engineering term, where terms come from. And boot, the only thing I came up, one of the classes I was teaching, somebody said, well, maybe years ago, people used to keep cash in their boots, right? And I'm thinking, maybe that's where it came from, right? So boot is basically money outside of an exchange, leftover money, if you will. Okay. So as we said before, taking money at closing or money that you didn't use all in the exchange, that's boot money. What's interesting is there's also mortgage boot. And this is what usually is a tough thing for people to understand. And it was tough for me in the beginning too. I'm thinking, wait a minute. So let's run that scenario that we talked about before. Let's say you had $1 million net sale and you had a $500,000 mortgage on it. And you find a great deal at $950 or $980, but let's say $950, right? And you say, okay, I have $500,000 in the exchange account. I'm going to put all that in, but I only need a $450 mortgage though to get to $950. I don't need a full $500,000 mortgage. So I used up all my cash, check the box, but I only needed $450 mortgage, not a $500,000 mortgage. That $50,000 short of mortgage is taxable. That's what floors people. That's mortgage boot. So you still came short. And the way I tell people is this, going back to what the concept of 1031s are, deed swap. You and I swap deeds with each other. You have $1 million deed, I have one. We swap it because we agree the values are the same. In your scenario, you didn't do an even swap. You swapped $1 million for $950. The fact that it was mortgage or cash is irrelevant. You're short 50. Now, you don't want to overspend either. I'm not suggesting overspend just to overspend, but you're short. Whether you're cash or debt short doesn't matter. You're short. That's what it is. It's called boot. It's short of money or money outside the exchange. Now, could you buy another property and use up to 50 towards another property? Sure you can. The property doesn't have to be $50,000. It could, but as long as you put that 50 towards another purchase, you're good to go. But when it gets smaller amounts and stuff like that, a lot of times people say, I'll just pay the tax.
Yeah, take it. You pay the little bit of tax.
Yeah, but I don't want them worried about it. Knowing going into it up front, eyes wide open, we're seeing what we're doing. We're good to go.
Touch a little, pay a little.
Exactly right. Yeah. Or not if you have an offset with losses. But yes.
There you go. Good point.
But I tell them that CPA, but go as if you had to pay it.
Sure. Okay, so let's just redefine capital gain. How do you calculate capital gain? Let's redefine that real quick.
So capital gain is taking the net sale and subtract your net cost. The key on that is the net sale is easy. Take your settlement statement after you pay your bills at closing. That net number is it. Now, it's the net sale price. So if you had a mortgage, the easy way to calculate it, it's not always the exact number, but it's close. And I'll tell you why I say it in a second, is take your debt payoff, if any, add it to your net cash that would go into your pocket or goes into the exchange account. Add those two numbers together, there's your net sale. Now, the only thing that changed with that are non-closing costs. Like let's say they put rent prorations on there. That's rent income. That's not closing cost. Even though it's settled at closing and should be settled at closing, it's not a closing cost. So we recommend the title company put it sideways on the side accounting sheet, let's say. Most don't do that because it's just easier to put it on there. So we'll capture that on our summary and say, oh, by the way, you had these items that were non-closing costs. We're adding that back in to your net sale price or target spend. The other one would be like security deposits. That's tenant money. It should be kept in a separate account, the deal with that.
Sure.
But sometimes they settle it all one time. And again, nothing wrong with it per se, but we capture that. So the easy, quick way of finding your net sale price is that cash plus debt. And if there's other extenuating things, we'll throw it in there, but usually they're not big numbers, right? So that's your net sale price. And then you go to the account and say, what's our cost basis time of sale again? Subtract it out, there's your gain.
There you go.
That's how when we're in the first conversation, second conversation, that's how we're a working idea what that is, enough to have a conversation strategy. So.
Yeah, and you can understand what the value of the 1031 exchange is. And that's
exactly right.
That's will then make the decision if this makes sense to do or not, if it's worth the effort, et cetera.
Right. And then we can also go into our role, if you want, on how we function and what an intermediary's role and what we do, if you want.
We definitely need to touch on that. Yeah. Okay. Let's run through a few more terms here. Constructive receipt. Perfect.
Okay. So I always like figuring out where they come from with these things. Constructive receipt is basically control of funds. So some people will say to me, oh, I just found out about the exchange, but I think I'm good. Where you guys come in, all that. And I said, well, okay, when did you close? Or they said, I sold my property. I go, did you close yet? Because selling and closing can be two different things, right? So they say, well, yeah, we closed last week. I go, oh, where's the money? Oh, it's in my bank account, but I'm good because I had my attorney open a separate account. It's the attorney's account, and it matches to the penny what's on the settlement statement, the number we just talked about. So I'm good, right? And I go, no, because you have control of the funds, even if they're not directly in your possession.
Because an attorney is your fiduciary, basically.
Exactly right. They have to do what they're holding on your behalf at your direction, right?
Mm-hmm.
So that if it's controlled, even if it's not directly in your control, it's construct a receipt or touch money, pay tax. I mean, that's what I tell people, keep it easy.
Awesome. Okay. So that's important to know. You can't touch money, you pay even
taxes. If it's not directly
Yep.
you touching.
Yep.
Because some people say, well, I didn't touch that account. I go, well, who did it get sent to? Right?
Yeah.
You're the seller. They have to send it to you. Right? That's just how it works.
So, and then how do you define exchanger?
So exchanger is any tax-paying entity that wants to do an exchange. So it could be an individual, could be a trust, a partnership, an LLC, a corp, SC corp, whatever. Whoever the tax-paying entity wants to do the exchange is the exchanger.
Tax-paying entity, not
Correct. That's the
Larry
key.
wants to do an exchange.
Could be Larry.
It could be.
Could be Larry's entity.
Yep, exactly.
And that's the key
Cool.
to keep in mind is let's say we pull, I ask somebody, if I pulled the title today, who's on the title? Who's on the deed? And they'll say, it's so funny. A lot of times people say, well, I'm on the deed. And then I say, well, if I pulled the deed today, who'll be on it? They go, well, my wife or my spouse is on there too. I'll go, okay, so there's two people on title. And it's not that they forget that, but they're kind of the lead person for the partnership, whatever. But we need to flush that out because that's who the exchangers are. Yeah, in that case too.
So let's talk about like kind. We talked about this before. Let's define that real quick.
So like kind, people think is type. Commercial to commercial, land to land, residential to residential. That's a very, very common expression. And like I said, when I wanted to research it, I went to the first paragraph of the tax code and it said non-recognition gain for properties used, real property used as an investment or business use. They didn't say anything about type. So an
like
easy
kind
example
is real property.
Right. Like an example I use in my class, I use like livestock of different sexes are not like kind to each other.
Yeah.
Right? Like so mama cow and papa cow, different business use. Papa cow is studding and basically, meat, right? Mama cow is milk and offspring. So even though they're like kind as livestock, they're not like kind to each other from the usage. That's the key.
All right, now let's define qualified property.
So great question. So qualified property, I don't want people thinking that they have to pre-qualify a property. Like, okay, before I do the exchange, Larry, let me make sure I get this approved by the IRS or some entity. It's just basically you and your team believe it qualifies to be exchanged because it was used as a business or investment use over the seasoning period. So you're voluntarily submitting to the IRS saying, we believe this property qualifies to be exchanged and that property qualifies to be replaced.
Yep, and the team's going to help make that decision. You're going to give that consult to a degree.
We'll educate them and here's what it is. What do you guys think? And they say, yes, it's a go.
Okay, let's talk about relinquished property and replacement property.
Okay, so relinquished is the one you're relinquishing title to. You are selling the property you're selling. Okay, that's what we call it. And the property you're buying, you're replacing with that because it's all about the deed swap. So you're relinquishing one title, acquiring another.
Yep.
That's why you can't exchange with yourself. That's why it's always a property you don't own already in the exchange because you can't exchange with yourself.
I think that's pretty easy.
Yeah.
Safe harbor.
So safe harbor, that's why I re-engineered that. So or I should say reverse engineered that. Safe harbor, if you think about it in a marine analogy, it's safe from ill or from battle or from anything. It keeps it probably safe. In this case, you provide safe harbor from taxation when you set up an exchange with an intermediary. So they're handling everything for you. You're not touching the money. You're not facilitating it yourself, or your team isn't.
So the intermediary, and we'll talk about your role in 2 seconds here, is creating that safe harbor.
Correct.
Yeah.
It's that environment. So basically that deed swap scenario, we create that deed swap in an extended time frame, not just a direct like somebody you find to swap with, let's say.
Okay. Vesting.
So vesting is a way of proving that the property that's sold and bought is the same taxpayer. So it doesn't mean that you have the same legal name. That's what's interesting about it, as long as it's the same taxpayer. So the easy one would be Larry sells, Larry buys. Drew sells, Drew buys. But what if, Larry, I want to put in an LLC. Can I do that? Well, as long as the LLC is a single member and it's you, the only member, it stays what's known as a disregarded entity. So for those that don't know what that is, it's an LLC that's formed with one member and it does not file a tax return because it doesn't have to.
It's pass-through entity.
So the IRS looks at it as the taxpayer is the member, not the entity. So two different legal entities, but the same tax entity. So vesting says taxpayer sale has to be taxpayer buy.
So let me give you an example. All right.
Yeah,
So Connor and I, my business partner, we have an entity that we are partners in. So it's an LLC, Connor and Larry, right? And then that entity owns a lot of other entities, and that entity. So basically, the best way to describe it, and those entities that it owns, each one of those entities owns an asset. And who owns that? And each one of those entities, the entity above, right? So it simplifies our tax returns because there's only one partnership, right?
Got it.
And so one K1 gets issued.
So each of those entities is a single member.
Correct.
The single member is that overall one.
Yeah. So say we 1031, the Boca deals, right? And so there's like 4, however many LLCs, because each LLC owns each property, right? And each of those are owned by the master corporation there.
Yeah, so you could, that gives you flexibility. So let's say, and I don't know your situation, but just to illustrate, let's say each LLC is the name of a property address or something. That's a common thing, right?
Exactly. That's
so
what
123 Main Street LLC, but the member of that is your main, let's call it the holding company or the main entity, the master LLC, let's say. So when you sell that, the seller is that 123 Main Street LLC, right? So the exchanger is that entity because that's what's sold, right? Even though the owner of it is that master LLC. The interesting thing and the real creative thing is the buyer could be that LLC, could be a new LLC, again, same master as the member, or the master itself, or, well, not the individuals, but so it gives you multiple options on how to take title and keep the exchange intact. That's why vesting is critical. A lot of people don't realize that, well, I'm going to add my partner on this one, or can I bring somebody in? Yes, as long as they are additional tenant in common to your core.
Or say there's 4 of them like that I just described.
Yeah.
Is that 4 different 1031 exchanges?
For every sale is a new exchange.
Okay, so say I sell it to 4 individual people, then 4 different 1031s.
That would be 4 1031s unless you sell to one buyer altogether.
Yep, as a package deal.
Yeah, it depends. And that brings up, we get into the structure and the strategies, all different ways of structuring it. Because let's say we had somebody sell 10 properties and it was 10 individual exchanges because there are 10 transactions. That's 10 taxable events. So each one stands alone. It's a lot more to coordinate on that. Okay, It's not like a volume situation. That's a lot more work actually for us, but most importantly for the client.
Sure.
Because trying to get that, and we'll get to that later. But what if they sold all 10 to one buyer? That's one exchange. Because if you sell a property like that or a portfolio like that, they're not being sold individually, even though they're individual properties with their own financials. The structure is that they're sold together as one. It's not offered to sell individually. So it's kind of all or nothing. They're all in and they're all will buy. Right? Now, from a tax perspective, and we recommend this and they do this anyway, that the settlement statement in that situation would indicate the cost of each of the properties because they all could have different costs. Right? They could be different properties, right? They're not exact, even if they're the exact same type of property, let's say all duplexes, they might have different acquisition, they might have different this cost, that cost. So they're going to still maybe do a sub statement typically that indicates that. From a tax perspective, they're going to pull that out. But from a structure of 1031, it is one exchange. The challenge with that one, though, would be that you have, let's say you come up short. Maybe that's calculated like we talked about before. Let's say it's $1 million, come 950 again. Well, that 50, which one gets allocated to the 50 short? That's a CPA question.
Copy that. So
the other structure may be to do them individually. Yes, it's 10 exchanges, right? So 10 fees, if you will, which we'll get to later, but the fees aren't big. But it gives you the maximum flexibility because let's say you come up short, you can allocate the shortness to one of the properties that has the least gain, right? So use the money towards the most gains first, right? So if you come up short, it's not as big of a hit. So it kind of gives you that flexibility. See, I've done that before too. We run it, and years ago when we started running into these scenarios, that's what got me even going more because I'm like, and the guy was like, oh, that makes sense, yeah. Because why would you not do that? Right? You just think, I just got them all in. I got to get all these covered. But if you come up short, use the big ones first.
There's so many levers to pull. And especially if you plan ahead,
yeah,
there's even more levers to pull. So
right.
This is a cool example of that.
Yeah. Sure. And the nice thing is, yes, they can get super complicated. My comment too is 1031s are simple till they're not.
Yeah.
And sometimes you don't know until you get into it. But you're right. The planning, I can't stress that enough, is so critical because things will happen in real estate transactions that you can't forecast. Deal goes sideways. You find something wrong with the property. I mean, so many different things that there's no way for you to see ahead of time, right? So the planning is again critical because that way, as things change and evolve, you can move it around as you need to, and you're just not ruining it. Your whole plan's intact, right? So that's what we say about that too. But back to this, we try to simplify as much as we can because I want them pumped up. Remember, I don't want them to say, "Oh my God, that was so complicated. I'm never doing that again." But sometimes they're complicated just by the nature of what somebody's trying to do. So they already know it's complicated. It's the exchange that's not making it complicated, right? Because that's what I'm sensitive to. I want them to understand that we're here to simplify as much as we can. But sometimes the nature of what you're doing is complicated. We had a guy one time with 12 different trusts. I mean, and the way he set them up wasn't the most efficient way from a legal structure and a tax structure. So he asked us for a recommendation CPA. We gave him one, and they helped clean it up. Because he was, was moving things, making things happen, and they're just setting things up that they thought was a good structure, and actually wind up being more complicated than it had to be. And when we asked his attorney why they set it up the way, the attorney was not clear. Because I think it was a lot of things moving fast because he's very busy, and at that time it made sense for that one, but they weren't looking at the whole picture.
Sure.
And it just made our 1031s more complicated, but we were able to handle it. But most importantly, he was able to get a better structure down the road now. So he's a lot more calm. He's a lot more calm.
Foundation is important, right? Yeah.
Yeah, exactly.
And to think, just to be thoughtful about that early on is good. Again,
critical.
Just back to planning. So, all right, let's talk about your role, and then we'll go on to like just discussing like important dates and targets and stuff like that. So,
sure. So our role is if we're known as an intermediary, a qualified intermediary, accommodator, exchange service company, a bunch of different interchangeable terms, right? And what that is a third-party company, meaning we have not done business with you, meaning the exchanger, the taxpayer, in the last 2 years and anything else. So that's why attorneys can't do it for their clients and CPAs can't do it, brokers can't do it. Even if they felt confident enough to want to do it, most would not touch it unless you have experience with it, right? But it's really a third-party company that you engage to facilitate the process for you. Specifically, we don't have to do consultations at all. We're not obligated to do that. Right. So just so you know, a lot of companies don't do that.
A lot of companies don't. I was just going to say
that. And there's
that,
nothing wrong with that. They're not obligated to do that. I saw a need for that. I like doing it. And that was our niche. And that's really worked out well. And clients really resonate with it. But a company that doesn't do that is not doing anything wrong, first of all. Don't think that they're holding back or they're not obligated to do that. Okay. Our job is just to facilitate A to B. So we do documents that are prepared for each closing, no matter whether it's a sale or purchase, that have to be executed at closing. And they're pretty straightforward. So there's an agreement between us and the client, exchange agreement, if you will, or like-kind agreement. There's an assignment of contract because if you think about it, every exchange to make it work, if I'm coming in and that's the second part of what we do, we have to hold the funds from the sale. That way you don't touch it, right? We keep talking about that, right? So in order for us to perform that role, A, we have an agreement saying how we're going to work together and what our restrictions are and how we're going to do what we do. But logistically, we're not a party to the transaction until we are. So there's an assignment of contract that gets out there that both parties assign. Basically, the buyers, if the beginning of the exchange on the sale, the buyers say, we acknowledge this is happening. That's all they're really saying. But the seller says, we're going to allow this third-party company to step in as the seller. I'm assigning the rights to the contract, not the obligations or title, to this entity to hold my funds for me. So that gives the green light, if you will, from the title company, instead of sending it directly to the seller, to send it to us as their agent, kind of, sort of, okay? Not a real estate agent or attorney or fiduciary per se. We're fiduciary to the 1031 rules and obligations, and to their direction when they want us to fund something. But if they want to do things that are outside the rules, we won't. We're not able to do that. And I'll give you an example in a second. So our role is that, to prepare those documents. Now, on top of that, we'll give written instructions to the closing agent. And we assume closing agents haven't done 1031s before. So we're very thorough and detailed, but simple terminologies, A, then B, then C type thing. And then we'll follow up with a phone call to the closing agent, whoever that person is, kind of walk them through it. Because we want them to save time. Here's the key factors. Here's what happens. Now, because we're part of the transaction now at closing, they're going to add our name to the settlement statement as qualified intermediary for whoever the exchanges are. Where a fee gets onto that, we'll cover fees in a second. And then we have them sign an acknowledgement, meaning the exchangers acknowledge that, yes, all these numbers on the settlement statement we agreed to, because we're not a party to that, right? And then there's a line which says how much goes into the exchange account. So that's kind of the sales side. And then there's 180 days that are the maximum before you have to get that purchase. So the sale and the purchase have to close within 180 days of each other, calendar days.
So sell side closes, clock starts 180
That's
days.
it. Right. Calendar days. So if the 108th day is a weekend or holiday, you don't have 180.
Yeah.
It's the day before that. Usually we don't get that
Day
far.
before.
The last business day before, right? Not
Okay.
after. It's not like your tax return. They give you an extra day or two.
Yeah, no. Okay.
Not like that at all. And there's no extension. So you have to have the two transactions completed within those timeframes. But the first 45 days after the close of the sale is critical. That's what they call the identification period. We call it the shopping period. You have to know what you're going to buy by that 45th day, midnight. In fact, we give you a form, an ID form you fill out.
So how does that work? Let's talk about that 45-day window. And obviously, when I work with clients, with you too, but when we work together, I'm usually, when I'm putting the property up for sale, as an example, if I'm the listing agent and then also facilitating the buy side, I'm already working with them because we've already planned ahead. We're already looking for property. We might even try to get one locked up so we can all feel comfy. But say the deal closes, we start looking. What does that look like from the rules perspective?
Right. So the rules only require that by the 45th day after the sale closes, you have to give basically in writing a list of properties, like a shopping list, if you will. And they're really only requiring an address, a closable address. So if you put 123 Main Street, for example, then you're telling you're buying the building. If it's a unit in the building, you got to put the unit number. So whatever specific exact property you're buying has to be put in there, first of all. And they have rules of identification. So bottom line is you have to identify in writing to us. Everybody gives a form. Our form's pretty detailed, has all the numbers and the deadlines on it. So you put addresses down a page. You could do it for the client or the client send it to us. Nowadays, it's an email, so we have a timestamp, so you can prove if they ever question you when you got it. And then from day 46 to day 180, we're in what we call the closing period. You're either closing what's on that list you just gave us, or you're waiting to get the money back, and the tax are due anything that's short. So that being said, 45 days is not a lot of time.
No.
Okay. And it doesn't matter what market, buyers or sellers market, doesn't matter. It's still not enough time. So what I tell people, we alluded to this earlier, is that I'd like you to think about selling and buying at the same time, matching sales cycle with purchase cycle. And that's why a broker, your data is critical, because you can say, all right, we'll get to a closing table in X number of days here. It's going to take us X time to find what you want to find. After we have the conversation, they're locked in. Now you know what they're going for. You're going to know what's going to be hard to find, easy to find it, or how much time you need to help them find it. Okay. And the cool thing is the time frame you can't change it once it starts, but you control when it starts.
Exactly. And that's the planning phase on my end. We
Exactly
control
right.
when we start looking, when we start getting a real strong clarity on what we think we're going to buy.
Exactly.
And also when we actually close. That'll be in the negotiation phase or the day we decide we want to list, whatever that looks like. We're doing all that. And as long as we know that's what we're going to do and we're super clear about it, this can be much easier.
Oh yeah. And especially the bigger the deal, the more transactions, the more critical it is to plan. I'll give you an example. We had somebody out of California one time buy 5 properties. They closed on the 5th property like a week after the 45th day, like dominoes. Boom,
That's
boom,
awesome.
boom. That took 3 months on their case, not us, their case, to set it up. Because they probably looked at 40, 50 properties or some number like that. I don't know, but you know it's a lot. They're to get the right fit, they needed the time to do so. So we had multiple meetings ahead of time, and then they just did what they do, right? That's what you're doing anyway. And they knew that they didn't have to feel rushed, but they knew what they wanted. And when they locked in, they locked in. There wasn't hesitating.
And that's the goal. Being on the buy side, we need to be able to lock in deals. So it depends on our client's circumstances.
Right.
Can we lock them in? Can we show that we are a qualified buyer before we've sold this property? Because in some cases, the buyer needs to sell to buy, right?
Right, to fund it.
Yeah. So in that case, well, then, I need to be savvy about how I'm presenting my buyer in this situation, and also make sure they don't get jammed up because we still got to sell this property.
Exactly.
So there's all these little tricks. There's a lot that goes into that depending on the client's situation. When the client's just very well-to-do and capable of buying as many properties as he wants, super easy. We just go ahead and we just go out and we go find these things and just make sure it time's right. And even if it doesn't hit the timing right, we have reverse exchanges for that. And you and I have done one of those.
Yeah,
together.
we'll talk about that. But to your point, the key is in the setup. And that's awesome because their situation kind of determines what you have to do.
Exactly.
You don't force something. So there's rules of identification now. Here's what's interesting, right? So somebody would say, well, I'll make it easy. I'm going to buy a property in the state of Florida.
Yeah.
They don't let you do that.
Identify every property on the market or every property in the state of Florida.
Exactly right.
Yeah.
I like this county. Pick one of those. You know what I mean? Anyway, it doesn't do that. So they have rules, and the rules are like this. So you can identify up to 3 properties without limitation. Okay. As soon as you identify more than 3, now they don't care how many. Now it's the dollars. So let's use the $1 million as the example. Let's say you netted $1 million. Forget about mortgage and all that. Let's say you net $1 million. If you identify more than 3, now they don't care how many you identify, but you can't identify more than 2 million or twice what you sold. The net sale price, right? So you say to yourself, wait a minute. Yeah. Think about that for a second, right?
That's not perfect.
No. So what we recommend in that is, well, let me go through the rules and I'll tell you what we recommend. So second rule is if you go more than 3, now you got to keep it to less than twice what you sold. If you happen to do more than twice what you sold, now you go to the third rule, which could kill the entire deal, the 1031, not the transactions, but the 1031. And that says that you identified more than 3, you identified more than twice what you sold. Let's say you put 2.1 on the list, right? Now you got to close on 95% of them, which means only one of those doesn't close, and now you killed the exchange.
And when you say you twice the net,
correct,
for each property or total? So
yeah, so it all starts with the net when you sold. So if we sold a net of $1 million, and you know you're going to identify more than 3, you can't put more than 2 million worth of properties on there. Doesn't matter if it's 20 of those, 2 of those, 5, doesn't matter. They don't care.
Yeah, that's not great.
Right. So let me tell. Well, the guy that I told you about before, he was in the 95% rule, and he closed them all.
That's awesome.
Yeah, because he was already over, and I was like, okay, we'll just keep going. But I didn't worry about it with them because it's their deal anyway, not ours. But I want them to succeed. But I knew how well they prepared, so it was just easy to fall down. Now, let me tell you how to work those rules, because once you know them, then you know how to work them effectively, right? So remember when I talked about how to spend the money? You have 3 options. You can buy something larger in dollars, same price, or multiples. There's only 3 ways you're going to go. Doesn't matter the type of exchange. Doesn't matter how much. Once you lock in on one of those 3, then the rules are easy. So let's look at that. Let's say you're going to buy something that's more money or something the same price. In those first 2, you're only buying 1. So you keep it 3 or less. Do not put more than 3 on that list.
So that works. That's
easy, right? So from a planning standpoint, you could put 1 or you could put 3. I've not seen many exchanges fail in 20 years where they identified 3 and only had to buy 1 of them.
In practice, when I'm running around with a client trying to figure this out, it's not super simple because we can identify 3. All of them could be under contract in a seller's market by the time we can actually execute a contract.
Right.
So that could be tough, right? So that's a hurdle. But again, if you're planning this right and we understand your circumstance, we might be able to lock that deal up, one of those deals up right away.
Exactly.
Right?
Well, see, you know the market, so you know how to work the market.
Exactly.
That's why it's critical to know that. You can't a lot of times you can't wing it on your own.
So before the clock starts, we're controlling when the clock starts in most cases. We're trying to get a clear understanding of that. Like how do we decide, choose 3 properties and one of which will get done in that circumstance?
Yeah, so I'll tell them my overall rule of thumb is by the time I get to the 45th day, I want one under contract from you and 1 backup.
Exactly.
Minimum of 2. That way, think about it. You're already vetting them out, making sure they fit, making sure that they are what they are. It's what you want and all that stuff. And that way, by the time you get to the 45th day, you already know.
Yeah,
okay? You already know.
That to me, like doing your side of the homework is the easy part as long as client's on board and locked in, right?
Right. And the motivation easy to lock them in is 2 things. The motivation of what they wanted to accomplish to begin with and the timing and the tax burden.
And the education. And that's where we come in here.
Right.
Yeah.
So if you think about it, so if their rule of thumb is 1 under contract, one backup, the only time you're going to put more than 3 is if you're buying more than 1. And usually they're a bunch of small ones. So you're not worried about the 200% rule, that second one, where you're going to be more than twice. So what we ask clients to do as a safe bet, I don't think anybody else does this, where on our identification form, we'll put your 200% number to the penny. So it's right in front of you. You know what it is. You're not guessing. Number 1. Number 2, after the 3rd line, and we just put 8 blank lines on the first page because that's how many we can fit. There's no strategy there, right?
Yeah.
But after the 3rd line, we put a little in red ink saying, if you're going to identify more than 3, basically stop and call us, right? Just make sure we go over the education there. But here's your 200% number. Make sure that we recommend, they don't have to do it, recommend, the next to each address, put the dollar amount of what the value is. either if you have them under contract, what the contract price is, or what the list price is. That way, you can total it up for the IRS and for your own purposes, see that you're under 200%. Total it up, make it easy. Don't guess. Because 3 years from now, God forbid you get audited, who's going to remember what these values of these properties were? Nobody.
Yeah.
But if you have it documented like that, throw it in a folder, whatever you have it. Here's the listing sheet. Here's the contract showing the price. That's where I got the number from. You're good to go, right? And that way, it's very easy on that. Now that I said all that, if I was doing an exchange, I'd sell 1 week and buy the next.
Yeah, same here. Or even reverse it if you can. If
Reverse.
You can
So
do
we
that.
can cover that. So the reverse it gets now we're getting the advanced class, which is fine. So, but the concept is easy. So reverse, basically you're reversing the order. You're buying first. Okay. You mentioned it before. You have to have the ability to do so and want to do so. Okay, that's first. The second thing is you can't take title to it right away.
Exactly.
That's the other thing that kind of we have to spend time explaining to the team, first to the client. So here's how it works. Let's say you're able to buy it first. Now you could buy it cash. You can get a loan against other assets or the property you're selling, pull the money out to buy it, or cash or whatever. So let's say you get past that. You're able to do it. You want to do it because the value is there and it's going to make it happen for you. And the market's dictating it. The challenge is if you took title to it right now you own it. So fast forward, now we go to sell what you're going to sell that it offsets this exchange. And you say, okay, I'm going to sell this property over here. I'm going to offset a property I already own. The IRS says you can't do that. You can't exchange with yourself. Even if you just bought it. Right.
Yep.
So we do in that case, we also add what's called a title holder service where the way we do it is we'll form a new LLC, no baggage, brand new LLC. Single member, our company's the single member. No baggage, no nothing to it, no assets, just a holding entity basically, right? And we will have you fund the money like you normally do. We'll take title to that. We'll give you a note for all the money you put up, a guarantee of the money, and a lease back of the property. And we have, obviously, the agreement's pretty healthy to cover that. And so what's happening is we'll hold title as your agent. And then you have 180 days to get the sale closed, same time frame, just sale now, and 45 days to identify what you're going to sell. Now, normally you know that, but sometimes you have multiple properties. One might sell faster than the other, so you can identify multiples.
How many? As many?
Same rule, three and all that stuff.
Copy
But usually it's not more than 3. We had one recently out of New York that was, I think they had 3. That's all. Usually it's 1 for the most part, but that's the key. So what you do is you go through the motions, you get this thing locked up. Now, the cool thing about the reverse is 1, you have almost unlimited time to make your purchase. Take your time. There's no time frame. It's very powerful, actually, especially in a hot market when the inventories are tight or really competitive. You can take your time to find something.
You can be opportunistic.
Oh, yes.
Yeah.
Jump on it when you can. Boom, you start the thing. Now, you're not worried about the sale closing because the market's strong typically, right? So you get that happen. Now, you can lease it immediately, though. That's what's beauty of it. A regular exchange, you have to wait to make the purchase. You're out of the rental income until the purchase finishes, right? No, you have rental income immediately if you can. It's beautiful. We give you a lease back of the property, but it's a pass-through lease. We're not charging you rent because it's your property, right? We're just holding on to it for this exchange period, right? So then fast forward, let's say the sale happens within 180 days. Usually it's a lot sooner than that. At the day of the sale, 3 things happen. We're going to do the paperwork. We have paperwork for each closing, as I mentioned. We're going to receive the funds into the exchange account. That's the other thing the intermediary does. We set up a separate account for each client. Most intermediaries do that, okay? And we close it when the exchange is over. So the separate account, we're in and out of account all the time. Every month we're in and out of accounts, which is safer, right? So we have the funds go in that exchange account. We turn right around and send them back to you, which pays off the note that we gave you for the money you put up for the reverse when it started. Now, they never line up because the sale and purchase are different prices. But we satisfy the note 2 ways, by giving you all the funds from the sale, right? We come to us, we turn around and send it to you. And we have your attorney prepare a deed to transfer the property over to you from us, or take over our LLC, whatever you want to do.
And they're typically preparing that all when we're closing the deal.
Yeah, I ask them to do it ahead of time because it's just easier. It's just easier to do
Yep.
it. Now, we can't execute it.
Exactly.
Because then it would kill it. Or we can sign it but not date it. That's an attorney's call, what they want us to do. That's fine. But the nice thing is there's 2 options on taking title back, and it just depends on what the client wants to do. We could have the attorney prepare a deed. We just sign the deed. They file the deed. Game over. The nice thing is it's not another closing. Like some people think, oh, there's doc stamps and all that. It's not. We're an agent returning title to principal. The only thing they're going to have if they do the deed is they're going to have to reissue the title insurance. So there's usually a discounted premium for that. But we cover that. I mean, the team covers that up front. And you weigh all that out to make sure it makes financial sense, or else you don't do the exchange. That's the normal thing. The other side is to take over their LLC. You can have our attorney prepare the membership interest transfer, and we'll just sign over the rights to the LLC, take over that. That doesn't work for multiple parties because, again, it's that single tenant, a taxpayer thing. But some people that want to do that, we can. So it's really up to them how they want to do that. But those three things happen. We want them to happen. Technically, need them to happen within a day of the closing of the sale. And then the reverse finishes.
We did one together recently in Delray. I was getting ready to list a property for a client, and he was looking for a bigger property, and we found one, and we found it to be a pretty good deal. And fortunately, he had the means to do this, so we right away locked that up. And while we were in this process, I was coaching him like, hey, you should consider this 1031 thing.
Right.
And, he was taking a little bit of his time anyway. He's a great guy.
Right.
So we eventually got everybody on a group call, the family office and him and you and me, and we all kind of talked strategy here.
Yeah.
And that ended up working out amazingly for him. We sold his property in, I think, the day before it actually even was showed. Someone called us up.
Wow,
I'll give you everything for it, right? Yep. And in fact, it was an amazing deal for him. So it all worked out really well. So he found a deal that he could add value to. He sold a deal that he already added value to for max dollars, and it worked out really well. And he bought something worth more money. He also, again, had the means, so he just paid cash for the other deal too, right? Technically.
Yeah.
And we did this reverse exchange structure, which worked out really well. And so we did all that within like 30, 60 days. It was already all wrapped up, which was efficient. So this can be very useful.
Yeah, it's funny bringing it up because I tell people, think of the 1031 as a tool. Knowing how to use it, how not to use it, when to use it, what type to use it is critical. I said, that's what I'm pretty good at. So you just tell me what the raw data, what your concepts are, and we'll put it together. Because sometimes, I mean, I don't expect them to know the reverse exchange or this exchange or
sure.
And they don't need to. Just tell me what you're trying to do, and we'll figure out if that works in this case or not. And for him, that was a no-brainer, actually.
Yeah, that worked well. And then you continued, I think, to do other 1031 exchanges with him throughout the country, right?
Yeah, I think up north and stuff like that. Yeah, and that's what happens with our business. That's why we've been blessed. I said before about the organic growth we've had. It's people telling people. And people say, well, I'm in this state. Can you do business there? I said, sure, we can. Because you want us to do it, we can do it for you. It's a federal thing, not a state thing. So we're able to do that. And that's where, once they get that comfort, that's the critical thing for this, because we're handling their money, we're handling their paperwork, we're talking with their CPA and taxes. You got to have somebody that you're comfortable with, right? And that's what really helps with that when there's that experience with somebody else, right? So
now let's talk about just what you think are the key things to ask a 1031 intermediary.
Sure.
The things you think are important when deciding if you're going to work with a specific intermediary.
Sure. So like any service, you have to know that it exists. So
yeah.
If you don't know that it exists, you won't even know to ask that. But
for example, many years ago when I first met you, I was working with an attorney and I said, hey, who have you done a lot of 1031s with? Who do you recommend? I know of a bunch of companies, but which person do you think is good? Which one has held the money and then delivered it to the client multiple times for you? And he mentioned you, and then we built a relationship.
That's the case. So to that point, that's part of it.
Yep.
Referrals. You can find, internet has plenty of options there. But what's interesting when you search for 1031 intermediaries on the internet, you get a mixture of answers. You get people that are, most of them are brokers selling properties to 1031 exchangers that are looking for properties. You get companies that do what we do. We have people explain things. So it's kind of tough to find that. But if you haven't hired the service for, here's a couple of basic questions. Obviously, what's the experience of the agent? How do they do business? Who the players? In other words, do they have like a title company? Do they have like a pre-person, post person, operation in the middle, the facilitator in the middle? Who are the players? Who's who on their team? Because if you're the broker, you're the agent, or you're the client, you want to know who you're dealing with, right? So you want to know who that is, right? You also want to know how they handle the money. You want to know about safety and security, right? So there's, in the banking community, and recently we've had bank failures and stuff like that, where we're not worried about it because we lived through the failures before. Remember, I was just starting the company back then.
Yeah.
That was fun, right? Not
Yeah.
really, but that was fun. But the nice thing is working with banks every day, I was able to get notice of things happening before it hit the public, right? So we're able to make adjustments back then that kept everybody safe. And the same thing here. We're not seeing any issues with the banks we use. Like we use Capital One. We use a local bank, Paradise Bank, you know them as well. And Centennial and Ocean Bank. We use some of the banks because I know the players there. I know the senior, the managers and stuff. Some of the private banking people, right? Commercial lenders, commercial bankers. So there's a comfort with us too using them, right? And none of those have issues. We haven't heard anything that we'd be told before the public was told, right? Especially if we're holding people's money, they're going to let us know. And so you want to know that too. And you want to know how they're holding the money. Specifically, separate account for benefit of. So it'd be, for our company, it'd be the Private Exchange Group, Inc. for benefit of, FBO, fill in the taxpayer. Okay, that's how we hold the title. Just like it's a trust account, right, for them. And then it goes about. You also want to know the security of the bank. So banks do FDIC at $250K, right? So there's one option out there where you can send it out to a bunch of banks and keep it under $250 in all the banks. And there's a service that's provided. We have one of our accounts like that now. The challenge with that, though, is that to fund deals, we need time to do so. You need 2 days to get that out and back to where it has to go. And a lot of times we're not given 2 days. So there's some slowness of response on that. That's not us. But you can do that, right? But typically the bank is that FDIC insurance is it. So you want to make sure that the bank you're dealing with has strong financials. And that's why the ones we work with do. So that's one of the security. The other security is how the intermediary is holding the funds and how they process protecting the funds. So the given is, are you bonded? Are you E&O insurance, errors and omission insurance? And yes, we are. The typical is $1 million per occurrence. We have that, and $1 million for errors and omission insurance. Some intermediaries are part of big conglomerates that have other businesses, not just 1031s. So they have bigger bonds, let's say, right? But it's still, you have a bonding that's unique to our industry that you can't get unless you have certain connections with the trade group and are qualified to do so, right? Because it's a crime policy to protect the funds in case they're challenged or taken over. But the key about that, when I started the company, I was more focused on was, how do I put process in place to protect the client so we don't have to go to a bond? Because bond means the money's gone, right? Yeah. And that's the worst, because then you have not the money to do the funds. You're paying the tax on top of all that. And then you don't have the funds to invest in something else. So I work with banks over the years, and here's the way we put together. And a lot of companies do similar, but I think we're a little bit more than most, but similar. So a couple of things. Every time we have a request for funds, we follow 4 steps. And there's 4 sets of eyes on what's going on. See, the more eyes you can have on a movement of money or a transaction, the better. Okay? And it doesn't slow it up, because everybody wants it to happen, right? But the more eyes you have, and I found out in the beginning, that's the best way to do it. So let's walk it out. Let's say you have a contract that needs a deposit. Doesn't matter what the need is. Let's say deposit for a closing. You, the broker, or the client, depending on the situation, gives us a contract. Say, hey, Drew, we need X dollars to go to XYZ contract for this property. On that contract, as you know, has an escrow agent who's going to hold the funds. The parties agreed to that person, that group is going to hold it. So we will contact that person. So here, watch the 4. So we'll contact that office. What are we establishing now? We're establishing a rapport with them. 1-to-1, who in your office handles the wires? We're the 1031 company representing so-and-so. We need to get this funds to you. And sometimes they're not expecting yet if the contract just got signed, but they're aware of the client because they got told. And at least it makes them aware at that moment. Yeah. So there's an awareness there too. That's the rapport we're developing, right? So we say to them, okay, we established that you're going to hold the funds in this contract. Can you send us your wire instructions? So they'll send it electronically, usually a secure email. Then we put it in our system. We call them back to verify what we put in, not what they sent us. That's a key, right? So we're verifying our data entry is okay, right? Some cases they leave some numbers off to make sure you make the phone call. And that's great too. We do that with ours, right? When we're receiving funds, right? So here's now a second phone call to them to verify what we put in and the amount and everything, right? Then we verify it internally with what I just said, well, the data entry and match and all that. Then we send it a form to the client, a pre-filled out 1-pager through a secure email system that basically shows everything there. Very detailed, says where they're at in the exchange, what the exchange number is, the last 4 digits of the bank account, the beneficiary, the bank, what it's for, the file number, and any other notes that we have for them. I mean, it's a really detailed 1-pager. Clients are already expecting this. We already told them ahead of time. They review it, they sign it, comes to us. There's 3rd. Then we send it to the bank, and I have a rolling password of a very large password plus a rolling password plus multiple checks and balances within the bank to set up a wire and then release the wire. Cool thing also that we offer to clients is the ability that they could get a phone call from the bank if they wanted to. If they're really not sure, it's a first relationship, Drew, hey, you got referred by Larry, everything's great, but do you mind if that? I said, no, I don't mind at all. I could set up front before the money hits the account that the bank calls so-and-so, either their attorney or the client, to verify wires before they go out. So short of giving them control of the account, which would kill the exchange, that's, I found, the best combination of proactive upfront, protecting the money, and then the back end with the bonds and stuff, but mostly spending the time protecting upfront before it moves the account. And let's play it out. Let's say they call the client, and the client says, "Wait a minute, that's there's something wrong with that, right? Could be the amount, it could be something." That never happens, but let's say it did happen, right? I tell the client, "What do you think the bank's going to do?" The bank's going to call me and go,
"Whoa,
what's going on?"
Yeah.
There's your 4 eyes. Okay, protecting it before it leaves, right? All of what I just described could happen in 30 minutes.
Sure. Yeah.
So it's not necessarily dragged out. A lot of times we ask for 24-hour notice. We don't always get it. "Oh, Drew, I forgot. Can you send that deposit out today? It's 2 p.m. You know, we get that. And if we can get it out, we get it out. And we don't wait. I mean, we ask for the time because we don't want to, we never go around our process. We still follow the process. If somebody doesn't want us to. Sometimes they don't want us to. I'm like, too bad. We're going to do it, right? It's for your benefit, right? And what's nice about that is it's a comfort level. And the fact, even if the bank gets called and the bank says, "Wait a minute, we've done our job." I mean, we protected the funds before they left. And the client, everybody loves it. Now, one time I had a client say to me, "No, it's this account name, not the account number, the name." I said, "Verify the name." They gave us the name for one of his other accounts. And what do you think happened? That wire bounced because he was rushing. And that's why I went back to him. I said, "That's why we don't rush. And This is for your benefit, not ours."
Exactly.
So he apologized. We're good to go. But that's where that system protects. And we've had that in place for years at this point. It works very well. We sleep well at night. Everybody sleeps well. And again, more eyes is the best. That's how you protect it. Another question for them is, how do I manage the time frames? Some QIs will not get involved in that because they don't want to. Literally, they take not giving advice to the nth degree. Another one would be, will they work with the agents? Will they work with the CPAs? Will they entertain a phone call with CPA has a question?
And that's why it's awesome working with you because I mean, that's your day. You are like, I know this, you time block out and you're talking to different clients all day, helping them get the answers so they can decide if they need to move forward. And that may look like working with accountants. That might look like talking with family offices,
it's
whatever.
Funny you say that because
attorneys.
In the beginning, I was concerned, okay, can't get tax or legal advice, but it sounds like I'm giving advice. People told me, "Well, you could charge a separate service just for consulting." And I chose not to do that years ago because to me, it's too much like giving advice, right? But that's why you can say with disclaimers, "We're not giving advice." Or you can proactively bring the actual advice in with the CPAs, right? That's the difference. And I need that for them, not just to cover us per se. It's not even about that. It's part of it, but it's really about, we need their information. We need them part of the team to make this happen. So we're not doing that, but they need it. Right. So that's it. So those are the questions they ask the CPA. I'm sorry, an intermediary. Obviously the fees. So let me go through the fees.
That's what I was going to ask you. Cool.
So the fees are usually in the industry flat fees, right? Yeah.
Okay. All right. See that you guys are copy.
Okay. So I'll talk faster.
No, it's okay.
So the idea is that the fees are flat fees. So usually the industry ranges from $500 for an exchange to over $2,000. So you see a very small window of fee structure. It's really not a big expense, not cost prohibitive. And typically what the fee covers is the sale and a purchase. In other words, a complete exchange. Transactional activities for the sale and purchase, and you're good to go. Okay, paperwork, setting the bank account up, send it back. We're at $1,500 because we spend a little bit more time than most. But again, nobody in the industry is cost prohibitive at all. So to do the exchange, you're not talking about, I don't know if I want to spend the money. It's never usually an issue. In fact, in some cases, people can say, "I'm going to get it run because I'm going to give it a chance," right? So that's how the fee structure works. They're paid at the close of sale, and we usually don't charge on a purchase unless they have more than one. There's an additional, in our case, $500 for after the first purchase. So again, nominal.
Yeah, exactly. I mean, to spend that kind of money to get the reward or savings that you get by deferring the taxes is
like
just worth it.
Larger exchanges might charge more, like over $5 million, might have a $3,000 fee. A reverse exchange, a $5,000 fee. So you're not talking, again, it's not really cost prohibitive no matter what you do.
Yeah, exactly. And again, I like working with you because of the, call it consulting feature that's added into this.
Yeah.
So it's huge. All right, let's talk about just quickly. We've covered so much stuff like while we've been talking. So let's just talk about the types of exchanges just real quick. There's one that I wanted to touch on, and then I want to ask you a little bit just about just what you're seeing in the market today versus recently, and then we'll kind of wrap it up.
Okay, cool.
So types of exchanges, let's start there.
So simultaneous exchange is where you sell and buy within one day. It's almost a deed swap, but it's not because you have a separate closing with a separate closing. If it's within 24 hours, you don't need us technically because the funds can go from closing to closing, right? You're not touching it. But why most times people hire us because we have the agreement and we're directing traffic, quarterbacking it, kind of, sort of.
Paper trail.
And what if it gets a delay?
Yep.
We're already in place, right? And what if there's not, remember the money's not always the same, so we handle that difference. Second one's delayed. That means a delay between sale and purchase. That's most of them. Reverse, we covered already. Construction exchange, quick example. You sell for $1 million, you find a great deal at $800,000, needs $200,000 worth of work. So in that case, we borrow the technique from the reverse exchange. So if you're going to do that, we start a regular exchange up. The $1 million goes into the exchange account, like we talked about, and we form the LLC. We have our LLC take title of that $800,000 purchase with the $800,000 exchange account, right? And that way you're not touching it. That way the $200,000 left over is your own construction draw. You still have 180 days to finish it, but you don't have to finish the construction per se, but whatever you do finish using up that 200 counts, right? So every time at that point you say, Drew, I need an invoice to contractor X for walls or foundation. It's capital improvement. We'll send those funds. You're raising the value by that amount, and therefore you use up the exchange dollars. The race is to get it done in 180 days. Most of them, doesn't give you enough time to do a full construction. But if you have a good thing, a handle on what repairs you can get done, it's worth it.
Yeah. I think that, to your point, that can be useful in certain cases.
Exactly.
It's a little tricky in some cases, but it's doable.
I walk them through some scenarios of what makes sense and what doesn't, depending on what they're trying to do.
Awesome. So what do you think, where has the market gone for 1031s recently? Was it really crazy a year ago, 2 years ago? And is it similar? Like, what are you seeing in the market right now?
So it's interesting. I try not to watch the news because I deal in the real world type thing, right?
Yeah.
But to answer your question, last year from 2021 into 22, it went nuts. We were getting calls constantly about doing exchanges. Now, has it slowed down a little bit? Yes, but we're still consistently busy, which means, and the other part of that is most of our exchanges are finishing, which means they're selling and buying. Okay, so to me, and because we're pulling from multiple areas, that's a good indicator that there's stability there. Okay, they're still making it happen. There's still reasons of solving that problem, get out of A to get to B, right? So I'm still seeing that. We're still getting calls all the time, which is great. Okay, I've not seen it drop off. Now, has deals been affected by the mortgage situation? Absolutely. Okay, absolutely. There's deals have gone under as a result of the interest rates going up too fast, too soon. Okay, so some people have lost transactions on that. They just look for another buyer. Other people have lost purchases and they're looking for another purchase. So, and then what helped in Florida anyway was the hurricane extensions because they gave extensions for people, right? And they gave extensions when a hurricane or a disaster happens. IRS is pretty quick about coming out with, hey, any of the deadlines for these counties that were affected, taxpayers in those counties that are affected, get these deadlines extension, 1031s go with them typically. So for example, Ian, every county in Florida was affected, even though fully wasn't, it was listed as affected because they weren't sure, they had to make the call, right? So that extended a lot of deadlines that help people with that scenario. But the way the interest rates have jumped so fast has definitely hurt deals, but those that are not all mortgages are still going through as well. So it's not really, they still have high equity. And one other thing about that, I tell people, if you're selling high and buying high, you're not necessarily losing because you're doing a deed swap and this deed over here is better than that deed. So stay focused on that. People say, well, it's too high, I'm buying it. So, well, you benefited from the high market with the sale you just had. So let's continue to focus on the solution of what this guy is better than that guy.
Exactly. And that new deal could have better upside. It could have so many of the other benefits we discussed.
Exactly right.
So it's not, you shouldn't get caught up in that, right?
Exactly right. I tell them that.
Fear.
I have to really, the consultation is really also about getting back to the fundamentals of investing, believe it or not. It's kind of interesting. It's not just 1031s. It's about thinking about what you're trying to do. And let's stay focused on that and find something that works for that, because you can find it.
And I think also locally here in South Florida specifically, what I've been seeing is, you have a lot of money coming from outside of the state. And so 1031s tend to be popular still on the buy side here for sure, because people are 1031ing out of California, New York, and everywhere else in the country and bringing their money here, either because they're moving here, they want their properties close by, they feel like there's more upside here, whatever it is. The population growth here in South Florida is strong, all those things, whatever it looks like, that tends to keep, I think, our market strong here, which is why I think you're experiencing still healthy.
And other markets like that, like North Carolina and the Midwest area,
exactly.
Ohio, some of those areas. We've had some in Colorado. We had some in Louisiana, for example, and some, believe it or not, up north, but not as much. You're right. More of it's coming down from the high taxation areas to come into this area. And even in Georgia and stuff, we've had a bunch of activity. So I see it continue to be strong. I'm not seeing it fall off. Obviously, we want to make sure that we touch wood.
Yeah, exactly.
Make sure we touch real wood.
Yeah.
So, but the point is that we're watching and consulting still the same strategies for people. If you stay with the problem-solving thing, that is the critical thing, no matter what the market's doing. And I've seen it from the time when the market was really bad, right? When I first started the company, we talked about that, when that collapsed, till today, and I think there's a consistency that it's going to stay.
My mom and I talk about just doing deals with clients that make sense. So when we sit down with them and we talk through the process, it's like, does this make logical sense for them? And in most cases, if it doesn't make sense, it's not, and we identify that up front, we're going to communicate that to you. Like, hey, I'm not sure this entirely makes sense for you.
Right.
And I'm trying to understand your circumstances. I'm really trying to empathize with you, but this may not be the right decision for you. So are you sure you want to do this? I try to identify that up front, because if it doesn't make sense, likely a month down the road or however long down the road, we're not getting it done, because usually the clients become aware that it doesn't make sense or come to their senses. In some cases, it's a purely emotional transaction, and that's fine, and we get that too. So we do that. But yeah, so just serving people.
And it's funny, just to finish on that point, I realize that people, when they go into a 1031, they don't know it. So they think that there's something different about it rather than regular investing. Yesterday, I was talking to a guy, and he said, what about this investment, that? I said, that one won't work for you because you just told me it's not going to work. So don't sweat it. That one's not a liquid investment. So put out this money for that one that is, and put only what you want in that liquid. You should hear his voice. He was like, oh, that makes sense. Like, he could have figured that on his own, but he was still worried that the 1031 would have had a different angle on that. And I'm happy to let him know, take a deep breath. You're good.
It's why people hire coaches.
Exactly.
Just second
right.
set of eyes, like feedback, all the above.
Exactly.
So I think that covers 1031 exchanges. Actually, we could probably keep going, right? Because there's just, I could ask more questions actually, and I've refrained a little bit just to keep it more simple.
I could tell.
Yeah. So anyway, Drew, thanks for the time, man. Looking forward to doing more deals with you in the future. And if you guys watched this video till the end or listened to this audio till the end, I think Drew and I both want to work with you, because that's our personality. We want to get in the weeds, and we really want to understand stuff, and we want to work for you guys. So give us a ring, right?
Love it. I can't thank you enough. It's been an honor. Really appreciate the opportunity too, Larry.
Thanks, man. Thanks for the
You
time.
got it.
Cool.
Take care.